year up by about 3 basis points to 3.1%. We've talked about that inversion, so 2's higher, yesterday 10's lower, came very, very close to negative 40 basis points. Just today, Tom, you've got to go all the way back to the early 2000s, spring 2000, when we had about negative 56 basis points. We're not a million miles away, TK, on 2's versus 10's.
2's 10's is a huge deal. To me, it's front and center today, John. Currencies have quieted down a little bit. We've got an equity rally, including advancing this morning. I think Howard Ward pushed the market higher. John, 2's 10's is the heart of the debate right now.
Amazing to me, Tom, how few people believe in this rally. With the exception of maybe...
It's an August of doubt.
Maybe Credit Suisse and JP Morgan, others do not see this playing out very well at all. HSBC, as we discussed moments ago, calling all of this wishful thinking.
Yeah, I think, John, there's some optimism out there, but to be honest, it's being drowned out with the force of the doubt, the force of the gloom.
Resilience in the earnings,
yeah.
1. I'd say the ISM yesterday, strong, robust. 2, actually picked up. So many nuances here we're trying to work through, Tom. We've got this inventory story, the switch from goods back over to services. I think that's distorting the data in a way that is confusing for many people as well, Tom. And these are difficult moments to work out where we're going here.
And the shock of double-digit inflation, which takes us over to the central bank ballet. Right now, that ballet is on Bank of England. John will be leading our coverage with that here in 29 minutes. Jennifer McCune, right now, former Bank of England economist, head of the Global Economic Service at Capital Economics, will help us here and particularly help me. I want to start with what won't happen, Jennifer. The silence of Governor Bailey. What does he want to avoid talking about this morning?
Well, I'm not sure he'll want to avoid talking about anything specific. Of course, the Bank of England has come under some criticism for not acting faster, for not acting sooner. He'll want to stress that a lot of the rise in inflation has been about the supply side. There was relatively little that the bank could have done about that, and to avoid further criticism on that front. But I think the key for the bank will be in what it's signalling going forward, what the vote shows us, what the forecasts show us about just how fast the pace of tightening will be in future.
Does he make the decision, or is there a different structure there than the U.S. Central Bank? I mean, Catherine Mann, as a visitor from America, I believe is very hawkish, and there's others very dovish. Do they matter in the debate, or is this all about Governor Bailey?
Yeah, no, absolutely they matter. There's a vote. And while Governor Bailey will put forward a proposal for what the change should be today, it will be down to the committee at the end of the day. So that those votes will certainly be playing a role, and we think there's likely to be a pretty big shift at this meeting in favour of a 50 basis point hike.
The most important thing to recognise, Tom, when it comes to the Bank of England, say the Federal Reserve, is just the disproportionate importance of bank rate at the Bank of England, Tom, compared to funds rate over the Federal Reserve, because capital markets in the US are so important compared to, say, the UK. I remember when Governor Carney took over, Jennifer, and you'll remember this too, he talked about the importance of bank rate for consumer loans, for corporate loans, and that's very, very different here in America. So can you help me understand, when it comes to the Bank of England, how they push through bank rate just a little bit more, say, compared to, say, capital markets?
Yeah, well, everything's essentially priced off bank rate. It plays a really important role in the UK economy. Mortgages, in particular, are more often at variable rates than they are in the US, and that means that the pass-through from bank rate to those variable rate mortgages in particular, and hence onto households, is pretty significant. So it's very much a live issue, what's going to happen to the policy rate, and people watch it. You know, even in tabloids in the UK, the bank rate is well known, and people generally, I think, know what that rate is, and will be very interested to see whether there is a 50 basis point hike for the first time since the Bank of England's independence.
Given the importance of that rate, why is the Bank of England thinking about outright selling gilt, and they could announce that plan as soon as today?
Yeah, they could do. I think that's much less important than what's going to happen to bank rate. We already knew that the Bank of England's balance sheet was going to be reducing in size over time because it's allowing assets to mature. There are significant assets maturing, and it's not rolling that over in full. The question now is whether it's going to start actively selling gilts. We might get some indication of that today, but I think there's an assumption that it will do later this year and going into next year. So if it's just backing up that assumption that's already in the market, then I wouldn't expect a major reaction to that.
Jennifer, taking a step back, the Bank of England is uniquely positioned in a moment of pain where central banks are having to raise rates at the fastest pace in decades in the face of economic weakness. Bank of England faces perhaps more than the Federal Reserve and really is at the epicenter. How do they message this? How do they message what they are going for at a time when the economy is already weakening so substantially that you're seeing it translate into real-time data?
Yeah, I mean, that's absolutely right. It's an extremely difficult position for a central bank to be in. And I think it will have to convey that dilemma between the fact that inflation has been rising very quickly. It's very, very high, even compared to other advanced economies where inflation's also high. And wage growth is rising. We've got pretty strong wage growth in the UK too now. Real concerns about second round effects and that could lead to significant persistence in inflation. But at the same time, as you say, real weakness in the real economy, real signs that the very high energy prices and the effects of that on real incomes are starting to weigh on spending, and that's really dragging on the economy, and a really big risk that we fall into recession. Actually, we are predicting a technical recession in the UK economy later this year, but at the same time, we think that the Bank of England will continue raising rates to a peak of 3%. So it's likely to come under some criticism for that, but there's little else that it can do with these inflationary pressures.
Jennifer, from your seat when you were at the Bank of England as an economist, can you give us a sense of how important it is to the members on that central bank when they take a look at the pound and how much it has deteriorated versus both the euro as well as the dollar? This is an inflationary force. How do they deal with this? How do they factor this into what they're looking for in their rate decisions?
Yeah, well, it is a factor, and it feeds through mechanically into the Bank of England's inflation forecast. So the inflationary consequences of sterling's movements will be playing a role. But the Bank of England has been very clear always, and even in the recent past, that it doesn't target the exchange rate. It's not an explicit factor. But what will be playing a role is its influence on the inflation outlook and any additional upward pressure that it might be putting on inflation. I think really the labour market is the absolute key, though, and what's happening to wage growth and what businesses, including within the Bank of England's own survey of decision makers, think that they're going to do with wage growth in the future. And at the moment, the worrying evidence is that they intend to raise wage growth further.
Jennifer, great to catch up, especially with someone with experience at the Bank of England and inside those walls. Jennifer Micchione there of Capital Economics. TK, I mentioned that difference between the Bank of England and Fed funds. If you have a variable rate mortgage and that rate goes up, the next month you'll see it. And that's very, very different to how things play out.
Yeah, let's be clear, John. There's a lot of variable rate mortgages in the United Kingdom, right?
There are many, Tom. And in fact, that worked out through subprime, Tom, and the crisis around that, because if you had a variable rate mortgage back then, it dropped down to close to zero, didn't it, and stayed there for a long time.
Yeah, but you had the 6,000 square feet in Notting Hill, so that worked out as well. John, look at the difference in curve inversion. The difference in yield between the 2-year and the 10-year, the massive inversion in the United States really hearkening back, negative 37 basis points, and the flat line in the United Kingdom of 1 basis point. John, the pros make a real distinction here about deep inversion versus flatline.
And some serious inversion developing here in the United States, Lee. So that's something that you've really got to think about a little bit more.
Well, what you could say is that this is faith that the market has in the Federal Reserve. I mean, you could talk about Fed credibility, but in some ways, this is basically saying the Fed is as credible as ever before, and they're going to get rates back down to that 2% level or below. They're going to get inflation back there, and that is what you're seeing in the long end, even as people ratchet up what the Fed has to do to get there. And to me, that's sort of what the indication here is. They are expecting more work on the front end, which doesn't speak well to the economic outlook. Again, fueling those doubts.
Do you want to explain this equity market move on the Nasdaq up 0.6%, on the S&P up 0.4? A Bloomberg subscriber reached out to me, Tom.
Oh, here we go.
Smart individual, and they've got a lot to say about nominal growth and the importance of nominal growth and what that means for earnings.
Well, you know, I'm there.
I know you are.
From
I know you
Michael
are.
Darda and others, but let me explain that into the timeline of the third quarter into fourth quarter. If you say a resilient nominal growth, at the same time you're saying extended, more persistent inflation. That's sort of the translation of that, John.
I'll pick up on the price action now, Tom. Up around about 0.4 on the S&P, on the Nasdaq, up 0.6. Your bond market, TK's all over.
Dow
It looks like
futures
this.
up 94.
It's up a couple of basis points. Thanks for that, Tom. What's that, third of 1%?
Yeah,
Something like that.
I don't keep track of the
It's not what it was 20 years ago, that's for sure. It's a joke, Tom, about points on the Dow. Anyway, whatever. All right. The crude market looks like this, up about 1%, 91.61. What did you make of yesterday, Tom? Demand for gasoline in America. The driving season is not developing in the way that it typically does. People aren't driving.
Come on, it's an historic summer. We all know that. Our kids are bouncing off the walls post-pandemic. All the rules are being broken. Why should we have a repetition of normal times this summer? We're not.
Demand destruction, Elisa, is in the data.
Yeah, and that lack of driving, how much is that? What's behind the gas prices? Not the SPR release, not any additional production from anywhere. It's really the demand destruction that you're seeing in real time.
Paul Sankey has things to say, the founder and lead analyst at Sankey Research, joining us very shortly from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. Ukraine's President Volodymyr Zelensky wants direct talks with China's Xi Jinping. Zelensky says that Beijing hasn't replied to Ukraine's requests since the Russian invasion in February. He told the South China Morning Post that China could, quote, put the Russian Federation in a certain place. Bloomberg's learned that Senator Kyrsten Sinema is seeking to curb corporate taxes and keep a break for private equity in the Democratic's economic package. The Arizona Democrat will be a pivotal vote. Sinema wants to drop a provision from the bill that would scale back a tax break for fund managers known as carried interest. She also wants to narrow the 15% minimum tax on financial profits. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees, is trying to move back to profitability after both losses and scandals. SoftBank reportedly has raised as much as $22 billion by selling Alibaba derivatives. That's according to the Financial Times. The newspaper says SoftBank sold prepaid forward contracts on Alibaba that allows the Japanese company to raise cash immediately whilst keeping open the possibility of holding on to the shares. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply. I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade. At that point, I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
It's hard to overstate how disappointing this OPEC Plus decision is for the Biden administration. Frankly, it's the geopolitical equivalent of a slap in the face. The Biden administration made a huge miscalculation.
That was Isaac Boltanski, the BTIG Director of Policy Research from New York City this morning. Good morning. Alice Hochstein of the White House pushed back against that summary, that characterization of that decision yesterday. He said it was more than just about oil in Saudi Arabia. Futures right now up 1/3% on the S&P, on the NASDAQ up 0.5%. Yields just a little bit higher too, up 3 basis points to 273. Get a Bank of England decision in 12 minutes time, then on to data out of the United States a little bit later this morning, 8:30 Eastern, jobless claims. Tom, how much crude is actually out there for OPEC Plus to be pumping? That's the big question.
It's a mystery right now that you see not only in OPEC Plus, but really worldwide. It is a different world after what we've seen, and the bets made by strategists, some saying 120, even 150, maybe a few higher, and others really saying, wait a minute, demand is disappearing. Think $90 a Brent barrel, even down to a whispered 80. Paul Sankey has seen all of this before. On the edge of legendary, the founder and lead analyst at Sankey Research, who writes a strange and twisted note, which is almost Sankey's zeitgeist of what he's seen in earnings. Paul, I want to go to your wheelhouse, which is gaming the capital expenditure culture and belief of the big oil companies, the E&P companies, given CapEx inflation. It's gotten expensive to find the next marginal barrel.
Well, not in the Permian. I mean, I think they know where the oil is in Texas, but what they've stopped doing is spending the money that you're referring to on global exploration or trying to find the next big thing. Now, they have found one next big thing, which is Guyana, but that's just about all that's been significantly discovered over the past decade. And as you say, the expense of finding oil and the uncertainty of finding new oil particularly is really constraining global capacity badly. And then, as you've referred in the program already, OPEC just is out of capacity. I don't see it as a slap in the face from OPEC to the Biden administration. I see it as more of a shrug or a we're powerless move, that they really can't add any capacity. There's only Saudi and UAE that have any spare capacity left. And as was also noted, OPEC actually highlighted that they don't have any spare capacity and they're worried about it. So there's a real problem out there. And if it wasn't for the SPR release, the million barrel a day SPR release, we would be a lot higher.
They're not keeping it a secret. So walk me through things for next year, Paul. If we don't get a recession, if China comes back online, what this commodity market actually looks like, particularly in crude.
Yeah, funny enough, I was thinking about that just this morning, because 2023 does set up, and beyond actually, for very, very strong. Now, the one thing that is notable is that we're seeing weak US gasoline demand, and people are blaming that on government conspiracies and other nonsense. I think the cars are more efficient. If you look at vehicle miles traveled, they're high. So it's not necessarily a change in behavior. What it is a change in the kind of vehicle people are driving. And it's obviously not EVs, electric vehicles. It's just more efficient cars that turn off in traffic jams and everything else. I think that's what we're seeing, combined with marginal behavior change where people are less wasteful with gasoline when it's expensive.
Wait, Paul, are you saying that that shift in the type of vehicle has happened in the past 2 years so dramatically? Because what this data showed from the EIA was that the amount of driving over the summer has been less, going back even to 2020 during the peak of the pandemic.
Yeah, you've got me a bit with that one, because the speed of the change does look like there's also marginal behavior change. But I think underlying, it is a rolling significant increase in new car efficiency that would have a significant effect at the margin on US gasoline demand. Well, there's a tremendous amount of demand for gasoline in the US that's discretionary. And I think people also just take that one less trip, and everyone tends to behave in the same way. And that's the other effect that we're seeing as a result of high prices.
Paul, are you surprised that the market isn't responding more to the OPEC Plus saying themselves that they're bumping up against the limits of how much they can produce? That previously would have produced a really big response in markets. And it basically was just another thing in the day that got forgotten very quickly.
Yeah, I think it's like the yield curve. I think what you're seeing is the back end of the curve for oil is holding up. I still think it's low. But it is holding up as the front month is coming down. The front month is being attacked by the SPR in a very big way. So I think the big question, as John is highlighting, is what happens when we get China back and then the SPR has to turn off, I think, post the midterms. That really sets up for a very powerful 2023. This tape today, this equity tape, isn't buying 2023. It's buying a short-term bounce, short covering move. And as a result, nobody wants to own an oil company as they see the oil price falling towards turnaround season for the refiners. Turnaround season for the refiners will be the more important demand effect that we see over the coming months. So I'm kind of bearish right now, to be honest with you.
What's your oil price out 1 year? I mean, I'm confused here in that I'm hearing so many cross currents. Are you able to guesstimate Brent a year out?
Well, we had said that we thought we'd see 110 to 150 through summer, so we're losing that. It's tried to hold that level, but has essentially failed. I think it's easy to argue for $100 oil on an ongoing basis starting in 2023. I don't think you'll do much above 150 over time, simply because the demand elasticity, the effect of the strong dollar combined with that kind of oil price will hold you below that level. I'm not a buyer of the 200, 250 type crazy numbers. I just don't think we can sustain that.
Paul, just to be clear, you slipped in the word bearish. Near term, what's the downside?
Bearish? Me? Nobody wants a bearish oil analyst. I think over the next few months, as long as this SPR, which is going to keep coming at 1 million barrels a day, you've got to think that the whole of OPEC just added 100,000. And we're pumping a million a day that the US refiners can't absorb. It's too much for their capacity. They're running at full capacity. So the oil is actually being exported. Now, that is terrible energy security policy. There's no question about that. It's good market policy because they're hammering the oil price. So I think the other way of looking at it is, wow, we're at 90 with 1 million barrels a day of SPR release, which is an all-time historic high. It's a huge number at the margin, to be releasing that much oil on such a sustained basis. And it's going to happen for months more.
Downside, Paul, what's the number?
People are pointing, technical analysts, great chart readers like you, John, are pointing at 80.
Okay. Paul Sankey, thank you. Paul Sankey Research.
That was a great find.
I know. Paul, thank you. Setting the stage for a rally over the next year, though, Tom. Everything that Paul was saying just then is the reason the energy bulls aren't going away anytime soon.
It's not only the construction of a barrel, which Sankey's legendary for, but also his work with Adam Szymanski years ago. And that key word in there, John, elasticities. The translation of that from fancy bow tie talk is responsiveness. What is the responsiveness of demand to that move in price? You heard Mr. Sankey pour some cold water on the 150 plus price guess.
I heard the same thing. In about 5 minutes, we'll bring you the Bank of England rate decision. We'll catch up with Jordan Rochester, the G10 FX strategist over at Nomura. This market, the Economist, looking for something close to 50 basis points from Threadneedle Street. We'll find out if that's what we get in a few minutes' time. Going into it, futures stateside positive, up 1/3 on the S&P, on the Nasdaq up 0.5%. Yields a little bit higher by a couple of basis points, 272.64. With Tom Keane, Elisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis.
recession, but they do need things to slow down for inflation to continue to go lower.
Fed's got a lot of work yet to do. And we think inflation is going to be running still at 4+.
What I worry is on the other side, that the Fed works too fast and too much.
I think that the big issue we have in the market is that the Fed is not about to pivot.
We have right now about a 50-50 chance in terms of tipping over into a true recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is the biggest rate hike from the Bank of England in 27 years. Live from New York City this morning. Good morning, with Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. This is Bloomberg Surveillance. Futures positive by 0.25% on the S&P. TK, it's 50 from the BOE.
50, and it's a different 50 than the American economy. I really have trouble, John, with the equivalencies of the Fed to the Bank of England. It's two different stories. You're expert at this. I know Lizzie is as well. But the answer is sterling a little bit weaker off this historic moment.
In line with expectations, sterling unmoved off the back of this. Lisa, cable 121.80.
You know, looking at this is again a bank that's having to hike into weakness. How much does this outsized hike give some support to the pound? You are seeing a little bit of support. Is it enough, though, to be disinflationary at a time when that's exactly what they need in the face of incredibly high inflation and not a sign that it's really going to deflate on its own?
The split 8-1. 8 Bank of England officials looking for 50 basis points. Just one looking for a 25 basis point hike. Going through the headlines for us. Outside the Bank of England this morning is Lizzie Burden. Morning, Lizzie.
Morning, John.
What's your take on things?
Well, so this is very much in line with expectations. It was well trailed. Andrew Bailey, the governor, had said in his Mansion House speech that 50 basis points were on the table, although he didn't say it was locked in. So this is very much what markets and economists had expected. Obviously, there's lots of international pressure. The Fed and the ECB had gone for jumbo hikes, but it'll hurt consumers. It'll hurt people with mortgages. Rightmove says that the average home for first-time buyers mortgage payment will rise 5.5% to just over £1,000 a month. So it's going to be much harder for first-time buyers to get on the market at a time when that's really a political priority. You've also seen out of the BOE, the recession forecast is changed, the growth forecasts have changed. So they're now saying that a recession will begin in the fourth quarter and last all the way through next year. Frankly, John, it's a bit meaningless when we're about to get a new Prime Minister in the UK. They're obviously going to do more fiscally. Liz Truss wants to unleash a whole load of tax cuts to the tune of about £30 billion. Yes, that might be inflationary, but surely it will help to cushion the blow in recession terms. The bank's also boosted its forecast for the peak of inflation. So remember, it had seen double-digit inflation in the fall. It's not just that now, it's 13.3% in October, and that reflects the higher energy prices that we're going to see in the fall, but that could be even worse next year. We're going to get the press conference at 12:30. I think that you can definitely expect Andrew Bailey to get a load of questions about the political pressure he's been under recently. The front runner to be the next Prime Minister, Liz Truss, has been particularly scathing on the bank's record, curbing inflation, actually saying that she wants to change the BOE's mandate. But I think Andrew Bailey is probably just going to bat those questions off to the Treasury because it's for them to set the mandate. 13%
inflation in Q4, just brutal. Lizzie, great work. Lizzie Burden this morning outside the Bank of England. We'll hear from Governor Bailey in about 25 minutes' time. Tom, 13% inflation, recession in Q4, the Bank of England hiking 50 basis points. It's pretty toxic stuff. As Lizzie said, though, the fiscal picture not clear just yet.
For our American audience, the heritage of that statistic, John, 13.2%, I can't say enough about that. John, when we go to the United Kingdom, most of us go to what? 3 zones of, we get to Harrods is our farthest west we go. Once every 5 years we go to Bath to have a bath. Other than that, John, the deflation, the harmful deflation of the 30s, it's different over there.
They're getting squeezed, and they're getting squeezed even harder. Looking at the reaction in gilt yields lower at the long end by about 3 basis points, a bit higher at the front end by 3 basis points. Sterling fades a little bit. Cable negative by almost 1/10 now, 121.42. For those of you just tuning in, I'll give you a snapshot of the broader market to get things started stateside. Futures are positive by 0.25% on the S&P 500. On the Nasdaq 100 up by 4 0.4%. So we're lifting this equity market once again. Yields higher by a couple of basis points, call it 2 basis points higher on treasuries, 272.46, and some curve inversion that we haven't seen for a long, long time, very close to negative 40 basis points. So 50 basis points is the hike from the Bank of England. Standing by, Jordan Rochester, G10 FX strategist over at Nomura. Jordan, your reaction to this decision by the BOE?
Well, John, it's the simple case that this wasn't a big surprise from the Bank of England. We were expecting around 50 basis points. That's what we got today. Conversations with clients as well. 50 basis points from the Bank of England is probably the last 50 basis points from them. It's the first and the last since they became independent, probably. As for us, the view is that the situation in the energy market will decimate the incomes of UK workers. The consumer confidence is going to continue to fall. Consumption is going to continue to slow. And the Bank of England is going to potentially revise down their inflation forecast. So the last rate hike of this cycle is probably going to be November, is the view from us. And that means it's very unclear to me why today the Bank of England doing 50 is a reason to buy the pound. Now, if they did 75, you would have seen sterling head higher. But, John, the problem for markets is we're just not used to trading 1970s style stagflation. Yeah. Tom was mentioning there the 13% inflation really decimating people's ability to spend. The Bank of England will reflect on this. They've already put in their forecast. Today we saw they think the price cap goes up to 3,500 in October. That's about right. It's going up again in January to £3,800 per year for the average household. This is a massive amount of money coming out of the system just spent on energy.
Jordan, I think very much different than the Fed, where we have all the different Fed presidents, including Kansas City, where we'll visit at Jackson Hole. We perceive the Bank of England as the city and maybe London as well. What does 13% inflation do to the Bank of England's relationship with to go to the Premier League this weekend, to Liverpool, to Leicester, to Newcastle? What is the BOE relationship with the inflation the North will face?
Well, indeed, you mentioned, Tom, you haven't mentioned past Harrods. So one day me and John will have to take to our hometown, north of Birmingham and Sutton Coldfield. It will be felt a lot in the north. We're seeing lots of strikes being held around the UK. I was listening to one of the NHS union representatives just earlier this week, and the pay rises they're being offered after inflation adjusted, roughly 10% real pay cuts. It's essentially like asking workers to do a whole month of the year working for free or losing all of their statutory holidays. So the impact will be we're going to have more labour market strikes. This will potentially see wages go up. So it puts the Bank of England in a really strange place that they're raising rates. The consumer is being squeezed. That does lower their inflation forecast perhaps ahead. But if we do get a wage price spiral, this is very 1970s like. So they're going to be keeping an eye on that. And the way the Bank of England looks at it in the north, they use the Bank of England agent summary. We've only just got it now, so I'll need to look through those details that came out at the same time as this meeting. But they do get a holistic picture of the rest of the country through the agents, and they will be seeing this story that I've just laid out playing out around the country.
Jordan, I want to dig a little deeper into your idea that November will be the last rate hike. It will be the end of the rate hiking cycle of the Bank of England, raising questions about the front loading of monetary policy and monetary tightening that has been a big discussion. We have the Bank of England warning of a long recession. At what point does that pause in rate hikes lead to rate cuts, in your view?
It could happen quite quickly. The Bank of England was one of the first major central banks to raise rates. They started in December last year, whilst everyone was still talking about transitory and Omicron. So when the Bank of England kicked things off in December last year, it gives them the sort of the ability to end their rate hiking cycle earlier than most, and also introduce the idea of cuts. So we're looking for May cuts from the Bank of England, that sort of timing. And why? So inflation will still be higher than 2%. I actually think the risk reward is inflation doesn't fall down to 2% as quickly as the market's pricing. But the central banks will react to the situation in credit markets. If you look at the crossover spreads, you look at the ECB systemic risk, whatever you want to look at, the credit stress in the market is roughly around the same levels as the worst moments in the coronavirus panic of March 2020. I suspect the energy prices, 10 times higher than they were on average in Germany, will knock out the business models of many manufacturers. We're going to see credit stress lead to higher defaults, lead to unemployment rising. And that's why in Q4 and Q1, the story will change for central banks. Even though we'll have high inflation, there could be a dovish moment.
Jordan, South Sterling, still the trade for you?
Indeed. I think we've had a big move higher up to the 122 level. Not very fun for me holding a short for about that period, but the trend is lower in sterling. It has the same problems as Europe when it comes to this energy crisis. Its central bank has just done 50 basis points. Look back to the ECB meeting. They did 50 basis points. What did the euro do? Nothing. So just because central banks are doing these big rate hikes, it's not enough to defend their currency against what's a big terms of trade shock. The pound should essentially be trading towards 115 down to 110, just based on terms of trade alone. The price of the UK's exports have fallen, whilst the price of the UK's imports have skyrocketed. The UK needs a weaker currency to help its exchange rate.
Ugly. Jordan, just quickly, can you imagine if the Fed forecast a recession like this one that starts in 4Q and runs through the whole of next year?
Good point.
Could you see them ever
That's
doing
exactly
that,
what
Jordan?
we're forecasting.
Could you
It's
imagine?
what we're forecasting at Nomura, so I can see it happening, but they'll be a bit slower than us to get there.
Jordan, I know that's the Nomura call. Jordan Rochester there of Nomura. We'll take TK to Little Aston and not Aston, and that's a snobby joke, Tom, from Birmingham, which you won't get, but Jordan does.
You know, when you tour on, Lisa, help me here. Between Faro and Rochester, I can only understand about one every 4 words.
Really?
I mean, yeah, I mean, it's just lost in translation.
do Duolingo for
it's like
British.
watching Peaky
Duolingo for
Blinders. I'm
British.
like, you know, give me another drink.
Come on, guys,
I can't
brutal.
understand him. It's
I understand it all. I don't
know
think
you
it's
do.
brutal.
I know, he's just rude sometimes. That's all. Can you imagine if the Fed forecast this, Lisa?
They would never forecast
starting in
it.
4Q that goes for the whole of next year.
The issue is not the plausibility of that happening. The issue is them saying it out loud. The Fed would never say that out loud, and that, I think, is the distinction.
50 basis point hike by the Bank of England. Sterling weaker by a third of 1%. Yields lower at the long end by 7 basis points on a 10-year. So 2's 10's inverts for the first time since 2019 in the UK on a gilt curve. From New York, still more to come. Lee Ferridge in the next hour from State Street Global. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. There will be another attempt to save the landmark Iran nuclear deal. Diplomats from Iran, the US, and Europe will meet again in Vienna after months of deadlock. The accord fell apart after Donald Trump withdrew 4 years ago and reimposed sanctions on the Iranian economy. That led Iran to step up enrichment of uranium. The US Senate has voted overwhelmingly to add Finland and Sweden to NATO. It's a move aimed at bolstering the military alliance after Russia's invasion of Ukraine. Turkey is still threatening to block the two countries from joining. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees. It's trying to move back to profitability after losses and scandals. And shares of Alibaba are rising in pre-market trading. The Chinese e-commerce giant posted second quarter net income and revenue that were better than expected. Alibaba's cloud and media sales missed estimates, whilst sales at the China commerce segment shrank for the first time. The company says it saw signs of recovery in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digeon Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We only have about a 5 to 10% risk max that the Chinese and the U.S. will come to blows militarily. And if it happened, it would probably be inadvertent. We don't think Beijing or Washington want to have a military conflict here, any kind of an incident.
Robert McNally there on the situation over in China and beyond. From New York City this morning, good morning. Tom Keene, Lisa Bramis and Jonathan Ferro. Futures positive 2/10 on the S&P. The rally continues on the NASDAQ, up around about a quarter, call it a third of 1% higher. Yields a little bit higher on a US 10-year, a Treasury, by a basis point to 271.18. They are lower on a British 10-year. A gilt 10-year yield, lower, much lower. Look at this for a forecast. Can you imagine? You've got to hike 50 basis points. You're forecasting inflation to hit 13% and recession to start at the end of the year, Tom. That was the Bank of England 20 minutes ago.
We've certainly never seen that from the Fed. I mean, it's absolutely original. John, place in context right now how the two candidates will adapt and adjust to what we saw at 7:00. What will Truss and Sunak listen for in the press conference?
There is going to be a ton of pressure now, Tom, for them to do more on the fiscal side. And ultimately, that's what they're trying to do, if you're Liz Truss. Rishi Sunak, the former Chancellor, is essentially saying we've got to get the finances in order first. And ultimately, Tom, the more they do perhaps on the fiscal side, the more the Bank of England might have to lean in too.
Exactly.
Given what could happen with
Becomes a
inflation.
vicious circle.
And this is what Lizzie Burden said at the top of the programme as we broke down this decision. It's very hard to understand these forecasts without really knowing, Tom, what the fiscal picture will look like down in London and Westminster.
To our American audience on radio and TV, I really can't convey the differences here. The similarities are way overrated. There are differences and similarities with China and Washington. Jack Fitzpatrick joins, picking up the pieces on a Thursday after an historic week, and the week is not ended. Jack, I've taken a lot of solace from Foreign Affairs magazine. Richard Haas and David Sachs lead there with the response that we must have that is unambiguous. What clarity should we listen for from President Biden?
As it relates to the recent Taiwan trip and China, I think that there's been a lot of ambiguity, and the White House may even be leaning in a bit to some ambiguity because on one hand, you have the Speaker of the House visiting Taiwan despite warnings from the Chinese government. And yes, the U.S. has a close relationship with Taiwan, but you see, for example, the White House pushing back a bit, at least on the timing of a bill that was supposed to come up to formally treat Taiwan as a non-NATO ally. The Biden administration has said openly that the military had some concerns about Pelosi making this trip. They aren't going to openly fight her on that, but there is quite a bit of ambiguity, and it has put President Biden in a position where he wants to have communication with the Chinese side, but not entirely try to back off of the relationship with Taiwan.
Should we expect an announcement from Washington and Beijing over a meeting of the two parties?
I don't know about an announcement on a meeting of the two parties. There was the phone call recently, and obviously the White House doesn't want to cut off communications with the Chinese government. We'll have to see where the White House goes in the future, but they've made it a priority to have direct communication between President Biden and Xi Jinping, and have felt that's particularly important given the tension with Speaker Pelosi's visit.
It's a difficult time for President Biden's camp, especially because of all of the other issues domestically that are facing and what's coming down the pike. I'm wondering about what you're hearing about messaging ahead of tomorrow's jobs report. If it's strong, great, the economy is doing well, but not so great because that means the Fed will have to do more weakening, and all of a sudden people accuse President Biden of overseeing an economy heading for recession. How are they trying to get ahead of that?
Well, either way, the White House is not trying to message in a way on the economy that takes for granted some level of success on the economy. They've really lately been focused on acknowledging concerns about inflation. You see essentially the rebranding of their legislative proposals, or what they could get into the Inflation Reduction Act, as they're calling it, trying to focus on deficit reduction issues. So they even if the news is good, they're not exactly taking a victory lap on the economy. The president is talking about what he's trying to do with members of Congress to address inflation, and it's much more of a tone of conceding that there are significant issues, that this is not an economy that's going to be a huge success electorally for the Democrats in the midterms, but trying to make the case that they're doing what they can about it.
Hey, Jack, awesome to catch up. Jack Fitzpatrick there of Bloomberg Government down in Washington, D.C. Lisa, it's never easy, is it? It is never easy to get a bill together and get everyone on board.
Especially now when you have that much splintering within each party, let alone the dual parties. How much do you get people coalescing around a deal that really came together shockingly quickly and shockingly quietly, if you think about it? This is the stripped down, Build Back Better, rebranded as the Inflation Relief Act of 2022 that they're trying to push through.
Does it actually reduce inflation? And that's something we can talk about another time. Tom, no room for error, no space for error at all in that Senate for these Democrats.
Well, that's true. And again, this goes back to the heart of the matter, which is a victory that we saw in, 2020, and it's been a struggle the entire way and still continues to be a struggle domestically. And as we were talking to Jack there, John, I'm fascinated about the cohesive message to China into Q4, That doesn't even mention the COVID debate, which is still very tangible.
That's the number one debate, Tom. COVID zero. Paul Sankey talked about it moments ago, about an hour ago on this program. Lisa, can you have a complete picture of the oil market next year without understanding whether we've got COVID zero in China, lockdown, lock off? What is it?
Can you have a coherent understanding of the global economy, of trade? And we get those trade numbers at 8:30 in about an hour from the United States. Can you get any picture without understanding China's zero COVID policy, particularly with the energy market? And then how does this factor in to where the U.S. sees its leverage at a time of ratcheting up conflict between the U.S. and China?
I mean, John, I'm going to go back to your relationship on one of your other properties with Jay Pulaski. He won't get up early enough to talk to us. He will talk to you in a later decent morning hour, and it's about a Pacific Rim recovery. And the JP Morgan oil call folds right into a demand recovery off of emerging markets in Pacific Rim. It's not happening.
It's kind of you just to say that Jay only comes on because he likes to sleep longer, Tom.
That is. Well, it's like
same
with Mohammed.
What a great compliment to my team.
You know, Ilarian's the same thing.
Just Mohammed likes to sleep in too. That's the only reason he comes on with me as well.
Yeah.
Thanks. I appreciate that.
Things are
Tom.
great between you guys this morning.
No love lost today, hey?
I'm going to call Dr. Phil. I think
I'm
he
still
can
reeling
join.
from these forecasts over on Threadneedle Street at the Bank of England.
Truly stunning.
Recessions in the forecast
John.
for 4Q, 13% CPI. Brutal, Tom, brutal.
What about Sterling?
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
When big Big Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Of so much doubt, what a rally we've seen on the S&P, on the Nasdaq since the June 16th low. On the Nasdaq 100 up more than 19%, on the S&P 500 up more than 13%. Right now futures positive by a little more than 1/10% on the S&P. On the Nasdaq 100 up around 0.2%. You saw the bond market yesterday, how it responded to the Fed speak. Yields higher at the front end, but a drop at the long end, and the curve inversion, 2s versus 10s, getting close to negative 40 basis points at one point this morning. Right now, yields up again by 3 basis points on a 10-year, up only a basis point or so on a 10-year. So again, a little bit more curve flattening, a little bit more inversion. In the UK, about 30 minutes ago.
Do the hands again, John. The hands is very good.
That's the Tom Cruise thing.
On radio, it was great.
Impossible, the inversion thing anyway.
You look like you're landing an airplane.
Can I do the UK thing first?
Please.
Tom? We got some inversion briefly for a moment on 2s versus 10s on the gilt curve about 30 minutes ago, off the back of the Bank of England rate decision. The we've got a 50 basis point hike, and the Bank of England forecasting a recession in Q4 that lasts the whole of 2023. Tom, throw in 13% CPI, stir it up, and what have you got? Pretty brutal.
Do you have John Major? John, with all your perspective at Warwick and history, are we reduxing 91 into 92?
We will find out what the fiscal response will be from the next Prime Minister, which we expect it will be Liz Truss, Tom, based on the betting at the moment and where things are leaning. And if it's Liz Truss and she does more, Tom, I just wonder where that leaves the Bank of England. Do they have to do more? And Tom, you know what came after Major? Ultimately, what we got in Gordon Brown and Tony Blair was an independent central bank. Since we had an independent central bank,
there you go.
This is the biggest hike since then.
See, folks, that's your value add on surveillance.
That's your lot. You should just turn down a radio, change the channel, and move on, because from here, downhill. In fact, from here it gets better because Lisa speaks and Tom and I stop talking. Futures, positive. Let's get some stocks. Here's Bramo. Hey, Lisa.
Hey, I hope I can deliver on that. There are a lot of really interesting stories that go beyond the macro, and there are these micro currents. Alibaba among them. American depository receipts up almost 5% after being down about 20% year to date. They beat expectations just in their earnings, despite all of the headwinds, despite the zero COVID policy, despite regulatory oversight and crackdowns by the authorities there. Taiwan Semiconductor, I'm watching closely, up about 0.8% after we talked about Nancy Pelosi visiting the island and meeting actually with executives from the Taiwan Semiconductor Company, which is such a pivotal node in the entire global ecosystem, considering how much of our world depends on chips, that they are the major provider of them. Lyft, I'm watching closely. Those shares down about 60% year to date. They're up about 0.8%. They're reporting after the bell. Some of the other stories that are less positive today, based on some of the earnings outlooks. Clorox came out, disappointing earnings, down about 6% ahead of the open. This is a story about supply chains. It is more vulnerable to them at a time when people are demanding prices not rise that much. You are getting consumer pushback to some of the price increases. Eli Lilly came out. They talked about headwinds from the FX currents, about $400 million off their top line based on that. Those shares down about 3%. And then Lucid Group, poised to report earnings. They were talking about the forecast going forward. They halved their output expectations for 2022. The electric vehicle maker already down sharply year to date, down about 13% now ahead of the market. And Tom, the reason why these kinds of stories are interesting is because some stocks were bid up so dramatically after the pandemic or during the pandemic have come full circle. We have seen completely the wind knocked out of so many companies with most of the value taken out. And that is underpinning some of the ballasts of the market that have held in much better.
Futures of fate, the VIX under a stunning 22, 21.88 is really quite something here, less than an hour from jobless claims. This is a joy right now to be briefed in the chaos of this early August. Ed Al-Husseini joins us. to say senior interest rate strategist at Columbia Threadneedle barely describes the legit EM World Bank IMF cred that he brings, this out of Colgate University and a small college in Cambridge as well. Good morning. I want to go to your real job before you got this act at Columbia Threadneedle, which is at Moody's. You actually sat at a desk and rated EM. Are we heading towards what you and I studied in history of EM next year in 2023? How fragile is EM?
Yeah, it's a good question. I think there's a really long tail in emerging markets that is in distress. And we're seeing that in South Asia. We're seeing that in sub-Saharan Africa. The good news is the core of EM, the emerging markets that went through those crises in the 2000s, in the 90s, they've built up much better buffers.
They've got better practices now.
They've got better practice, better policy.
I look at this, let's bring it over to developed country. In the headline here, John's been wonderful on it. It's the shock and awe of 13.2% inflation. Can you explain to me almost the first derivative of the x-axis we're all going to live on this inflation battle? We're all thinking short-term quarters and that. It's a media thing. Are you looking at 1, 2, and 3 years for inflation to come in?
I think that's right. If you think about the challenge for central banks, I mean, both the Fed and the Bank of England is, of course, in a much more difficult spot, is the ability to build confidence that inflation will go back down to 2% over the next several years is exceptionally low right now. So what happens to the data over the next several quarters, in some ways, is a lot less important than those central banks' ability to be confident that they've tipped inflation over on a trajectory down to 2%. It's very, very difficult to get to that spot at this stage.
Ed, we were talking earlier this morning with the Bank of England. They came out and they project a recession that is long, that is painful, at the same time that they're raising rates. Could the Fed ever do that?
I think the answer's got to be yes. They're definitely committed to their credibility. They're committed to reestablishing credibility with respect to the 2% target, and they're in a corner where they essentially must hike and must tighten policy if they don't see inflation coming down to 2%. So there's very little reason to doubt them at this stage.
So what's the market getting wrong? Because the market seems to be thinking the Fed will be able to move away from some of their rate hiking sooner than previously thought, even with the recent repricing, because there is this entrenched belief that inflation will come down in the next couple of quarters.
It's probably a decent bet that inflation will come down. It's not clear if it will come down to 2%, and that's the key benchmark. If you look at market pricing, markets are priced for about 100 basis points of tightening over the next 4 to 5 meetings. That's an exceptionally narrow room for the Fed to maneuver. And so if anything, you're starting to see the Fed come out and start to push back a little bit against that, just to create space for them to maneuver if data surprises them again in the course of the next couple of quarters.
I guess I'm trying to understand some of the movements in the market because, yes, you have seen people expecting inflation to roll over, perhaps not as much as the biggest optimists. You're also seeing credit rally at a dramatic pace. You're seeing people pile in at a time when there is the expectation that at some point there will be a downturn, if not an outright recession. Does this seem like a faulty bet or one that's worth piling into based on how high yields got?
It's tricky because I think two things are true. First, if you look at growth and growth expectations, you can probably make the case that perhaps they got too negative in the course of the past couple of months. So we've hit a little bit of a floor in terms of growth. Data has surprised marginally to the upside since then. And so you see that kind of a relief rally in credit and risk more broadly. At the same time, it's clear that the Fed is not done. Tighter financial conditions are essentially a precondition for inflation coming down to 2%. So the foundation for the risk rally is, I would say, quite thin.
I want to go to Benjamin Friedman. I want to take the synthesis of all your academics and the work you did at Harvard and the great, great Benjamin Friedman and his worry about sustained growth. In the jumble that we're in 2022, is global growth at risk? Is this modern experiment of 6% China, decent growth in America, all the turmoil about inflation and that, is growth finally at risk?
I think it's a really good question. If you look at what's happening on the demographic side, we've been slowing progressively, really, over the course of the past several decades. China's population is set to slow. Birth rates in the U.S. are exceptionally low.
But what about the technological overlay?
The productivity is the key question. If you look at productivity of the last several years, it's been very disappointing. Productivity growth over the last several years is flat to negative this year. So unless there's a recovery in productivity, which is a significant question mark, I think long-run growth is likely to perhaps take a step down. And again, from an interest rate perspective, it creates a challenging environment because it's becoming more likely that interest rates go back to that secular stagnation, low demand, high savings place yet again once we're through this inflation window.
I just want to get that in, John, for our August gloom theme, August doubt theme.
Is that what it is, Tom?
That was it. You were just trying to maintain the theme.
And just climbing the wall of doubt.
He's got some real authority there, seriously.
Ed does, without a doubt. Ed, thank you. Ed Al-Husseini there of Columbia Threadneedle Investments. Just a mention of high yield. In a month, we've tightened 140 basis points, Lisa, in a single month. Wow. Typically, you'd think that happens after the Fed has made a major pivot. They have not made a major pivot, in the words of the central bank speakers themselves.
Yeah, I was actually speaking with Howard Marks of Oaktree about this, and he was, before that rally, thought that there was a good buy, and after that rally said the risk-reward is pretty evenly balanced at this point. I mean, it's completely repriced things, and you've seen people respond and companies respond by selling a whole load of debt because get in while you can, right? And that's certainly what we're seeing right now.
I love how careful Howard is with his words. The risk-reward. What did he say? The risk-reward what?
Well, you basically was saying it seems like a balanced risk.
Okay.
And it seemed like it was a less balanced risk to the upside before that.
And there you go, Tom.
He never comes on with us
some
either.
serious spread timing.
John,
Are you suggesting that he likes to sleep in too, Tom?
Yeah, we got to get Mr. Marks in here.
Is this your excuse for why people don't want to talk to you?
Yeah.
They want to stay in bed.
We could get Mohammed and Howard on together. That would be great.
That would be very cool.
Bring out Al-Husseini along. It'd be great.
That would be very cool.
All of us at a big table,
Yeah. In the same room?
Yeah.
That would be nice.
Over in Cambridge, road trip. Go see Mohammed.
Is it Mohammed's got Tang?
I love this.
No, I don't.
How did you get a road trip in here?
Never say it is the
Every
University
single
of
opportunity.
I know, it's not even an
That's
opportunity.
right, Tom. That's right. We'd be in a different time zone. That would change everything.
It would.
Then all these people would come on with you.
They would.
Futures on the S&P up 0.2%. I'm on board with that, Tom.
Really?
Just for a quarter or for the year?
Oh, no, move.
Oh, no,
like
for good.
move.
Move.
Take vet bill,
Okay.
take kennel fee,
That's how the kids.
move.
We're gone. Okay. All right. At least has got to talk to her sons about that. See what they say.
Sure.
They're ready to go. Okay. All right. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. In the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in the race to become Prime Minister. Truss is just receiving the backing of former Chancellor Sajid Javid. That's a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Wall Street CEOs don't want to spend any time in quarantine if they attend a Hong Kong conference in November. The conference is designed to advertise the financial hub's revival after more than 2 years of COVID restrictions. The CEOs of Morgan Stanley, Goldman Sachs and UBS are amongst those invited. Their banks want a guarantee of quarantine-free travel. And investment banking bonuses on Wall Street are likely to plunge this year, according to compensation consultant Johnson Associates. Incentive pay for those underwriting debt and equity could plunge more than 45%. Those advising on mergers and acquisitions could see their bonuses fall by 1/4. At the 5 largest Wall Street firms, investment banking revenue fell 43% in the first 6 months of the year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully. And, the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
I think that the big issue we have in the market is that the Fed is not about to pivot. And it's the same issue we have for many central banks around the world, right? Inflation is so high that it's just too early for central banks to come out and explicitly signal something new.
Jens Nordvig there of Exante Data. We're getting something new from the Bank of England, a 50 basis point hike. We haven't seen one of them for 27 years. Futures right now on the S&P are up a little more than 1/10%. The Nasdaq still rallying, up 0.2%. Your euro, unchanged, 101.69.
Yeah, look at sterling.
Yields up a basis point, 270, 137. We can look at sterling right now, Tom. Negative a half a basis point on cable. Sterling against the US dollar, 120.85. Wow. They are forecasting a recession. They're forecasting CPI at 13% at its peak, Tom. And this is going to get really, really messy and difficult for the British consumer, that's for sure.
Let's get right to it. Our conversation of the day on the United Kingdom with David Blanchflower, professor of economics at Dartmouth College. He darkened the door at the Bank of England a number of years ago. We're thrilled he could join us today. Danny, you've gone through the details, and you make it very clear that a la 1947, in a path to the Eisenhower deflation, the inflation panic is overwrought. This is a bank signaling a deflation or a substantial disinflation out to 2024. What should be policy if we model a future disinflation?
Well, obviously, the story is the forecast of a recession. 6 quarters of negative growth they're forecasting. But if you go to their, I think it's their chart 1.4, and what you see there is that there's a significant risk in 2024 of deflation. And there's the famous chart the Bank of England produces, shows you 800 years of inflation. And the one thing that stands out from it is the big risk when you have high inflation is that you generate deflation. And so that's obviously the worry. I mean, the truth is, John is right. They're forecasting 13% inflation pretty soon this year, but by 2024, this thing plummets. And I think the likelihood is actually that this forecast is overly optimistic. I think the chances are the unemployment rate is going to rise by much more. Output is probably, I mean, it may not last for 6 quarters, but output probably is going to be weaker. And we're probably going to see the bank having to U-turn pretty fast. I mean, this is a devastating, terrible forecast. I'm sorry, last point. I remember in 2008 in August, so a number of reports ago, and the big deal then was the UK was in recession, and they didn't use the word recession. The word recession is all over this report. So this is devastating. But I think the argument that balance of risks is balanced, Lisa just talked about it, risks are actually very strongly to the downside to this. So why they actually raise rates, sort of unclear when you read the thing.
Well, Danny, let's talk about how original this moment truly is. And can you imagine the Federal Reserve forecasting a recession in the way that the Bank of England has done today? And why do you think that's the case?
Well, I think in some ways they're under huge political pressure to try and deal with the interest rate, with the inflation rate story. I mean, Truss came out this morning and said the bank should have raised rates earlier, and we're going to relook at the remit. So I think the politics of it are pretty interesting. I mean, the fact that the word recession is in this report. I don't know of any other monetary policy report that has that word. As I said, go back to the August 2008. They didn't even use the word recession when they were in recession. So obviously some of the question is, how quickly does recession come, and how quickly does the bad data come? But we've got bad PMIs this morning, sales of UK cars down 11%. I mean, this baby could get bad pretty quickly. And I think, as you say, the likelihood of the Fed doing this is really pretty different. But I think this is pretty unique for the MPC. I've not seen anything like this in all my time Bank of England watching.
When you're talking about the balance of risks and how it's incredibly skewed to the downside, how do you then respond to Jordan Rochester's point about a wage spiral that you're actually starting to see in a very real way, and how this bank gets ahead of that to curtail that, even if it requires some sort of recession or significant downside in the near term?
Well, we've been talking about non-existent wage spiral since 2008, which we haven't seen. I mean, we've seen some attempt to try and keep up nominal wage growth. We've seen big falls in real wages. I think the idea of a wage price spiral in the United States and in the UK is for the birds. I mean, we're seeing settlements around 4%. We're seeing public sector workers saying, we need to try and maintain our living standards. The chance that any of this is driven by workers demanding and getting higher wage increases, I see absolutely none of that. None of it in the United States, none of it in Europe, none of it in the UK. We're talking about 13% inflation and workers asking for 4% pay raises. This is not driven, none of this is driven by wages. So I think that whole argument is just nonsense.
Danny, a lot of people are saying that right now this is the Bank of England front-loading rate hikes, that they're going to start cutting rates, or at least pausing the rate hikes later this year, then cutting next year. And that seems to be this belief with the Fed as well, that yes, there are some pretty significant rate hikes, but it is a front-loading to try to get ahead of the inflationary push. Why do you think that's a bad idea, to see what you can do now and then wait and then see how it trickles out?
Lisa, it's a great point. But I mean, I always had the view that you say what we need to do is get rates up to try and cut them later from the recession that you've caused. So obviously that seems like a problem. I mean, the bigger issue in some sense, Lisa, is that, yes, you've now got rates up. We're talking globally around 2 or something, less in the euro area. The problem actually is, think back to 2008, we could cut from 5% to a half or 0. The room for the central bank to cut is limited. It's going to fall on fiscal authorities. Look in the UK. There's basically no prime minister. There's no chancellor of the exchequer. People are talking about the plans that they might have, but the pressure is going to come on a new chancellor and a new prime minister pretty darn quickly, and the markets are going to speak, and they're going to say whether they think this is appropriate or not. I mean, we don't even know who the chancellor would be in September when these bad data come in. So I agree with you, but it looks to me that you front load interest rate rises for the recession that you worsened by doing it. So I think there was a significant argument today to actually sit pat and wait, because it's unclear that these rate rises are going to do anything to bring inflation down, being caused by global oil prices. How is these interest rates actually going to do anything other than tank the economy? How do they actually bring prices down? And Bailey's already admitted that basically it can't. So I think there was a strong argument to sit, wait and watch. But the political argument was a very strong one, because the trust was threatening the remit of the banks, and they should have raised rates earlier.
Well, I'm not surprised you said that at the end there, Danny. That's for sure. Danny Blanchflower. Danny, always good to catch up from Dartmouth College. Governor Bailey saying this moments ago: our forecasts are, quote, exceptionally large. The risks around them. The risks around our forecasts are, quote, exceptionally large, Tom. And I think that probably holds true for most forecasts looking out anything beyond 3 months at the moment.
I was going to say 3 weeks. I mean, can we get to the November Fed meeting? I don't think so. Not a chance. We have to focus on the data, including August 10th, John, to September.
Inflation data next week here in the United States with Tom Keene and Lisa Abravitz. I'm Jonathan Ferro. Futures are up 0.1% from New York City. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The market is kind of looking through what the Fed and other central banks are saying right now.
I think the Fed's been trying to reset and say, hey guys, we didn't really pivot. You may have thought that, but we didn't do it.
It is possible to cool the labor market and cool the economy without seeing a real large increase in unemployment rate.
We're going to be disinflation. We're going to go through disinflation in the future. Now, I can't tell you when it's going to happen.
We wouldn't be particularly aggressive at this point, and we're just suggesting patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A most momentous Thursday into the jobs report tomorrow. Claims in this hour, but all eyes on the United Kingdom. There's no other way to put it, John. History made this morning as Governor Bailey speaks now.
What an original moment, Tom, to see a central bank forecast a recession that starts in 4Q and goes through the whole of next year, together with 13% inflation and a 50 basis point rate hike. That's a pretty original moment, Tom.
27 years back, I go back to 1995, John. You remember it, John Major as prime minister, coming off the 1992 chaos. John, that was when Arsenal, they acquired Inter Milan's Dennis Bergkamp. That was really something to see.
How do you remember that? I don't
remember it, but I looked it up because I remember there was this incredible trade between Inter Milan and Arsenal back then. But it harkens back, John, seriously, not to the success he had at Arsenal, but I'm only doing this for Kit Jukes.
Sure.
The reason, John, is it harkens back to that early 90s uncertainty. Do you sense that uncertainty now in your England?
Without a doubt. And Tom, I'd go further. You have to recognize this is the biggest rate hike from this central bank since it became independent. And independence of the Bank of England, Tom, isn't that old. It's the late 90s.
Yes.
I think people forget that. And Tom, you remember the story of the last 10 years. We were talking about this independent central bank story, how credible they've been at keeping inflation down. That's changed over the last year. And there's some political pressure building on both the Bank of England and, for that matter, this Federal Reserve too.
Hey, John, moments ago, this is the headline we've been waiting for. The governor saying not for the independent Bank of England to get involved in leadership election. Baloney, they did this morning.
And Tom, we'll find out if it is Liz Truss, and if it is Liz Truss, whether she comes out with a bigger fiscal package. That's what this market at the moment is very focused on when it comes to the UK. How big is the fiscal effort, and what does that mean for the Bank of England offset that might come down the road?
Sterling weaker here, 120.85. When we go to the bond market, Lisa Abramowitz, it's real simple. Fixed income speaks.
Fixed income is speaking, and it's not speaking in a very nice way. And honestly, stocks have taken notice as well. You've seen a lot of the gains in the early morning fade substantially. They're coming back a little bit, but it basically was a flat tape just moments ago. Bond yields coming down. How much is this in anticipation of the weakness that people are expecting from the moves that the central banks are going to make? And I look at the curve inversion, which reached 37 basis points. In other words, the 2-year yield was 37 basis points above the 10-year yield just moments ago, at a time when people look at that as a recession signal, and it really is flashing some red signs.
Well, we're going to have to see. Let's get to the data right away. We've got so much to talk about here this morning. John, I'm going to go to the continued equity lift that we see. It's somewhat off the radar given the macro news, but nevertheless a resiliency indicated by the VIX. 21.99.
What a rally we've had, up 19% from the lows on the Nasdaq 100, up 13% from the June lows on the S&P 500, and futures go again by about 0.1%. Yields unchanged on a 10-year, 269.91, was sub 270 on a 10-year. We add a little bit more weight onto the 2-year over the last couple of days, just a ton of hawkish Fed speak, disrupting the bond market, and as Lisa said many times over the last couple of days, doing very little to disrupt the flow into the equity market. On the Bank of England, Mohammed Al-Arian just out on Twitter right in this, Tom. The Bank of England continuing, quote, with what has been the most direct and honest commentary of any major central bank.
No question about that.
We have not heard this kind of commentary from anybody, Tom, in a central bank about how dire they think this outlook is.
And someone with that perspective, Lee Farage joins us now, head of macro strategy for North America at State Street Global Markets with decades of experience. Lee, I'm going to cut to the American chase for those on radio and TV. Can the angst of Governor Bailey migrate across the Atlantic and become the angst of Chairman Powell?
Oh, I think almost certainly. I mean, you know, as you just mentioned, I mean, the Bank of England is being the most honest of the central banks. They're predicting a recession that will last for 5 quarters, so a prolonged recession, and yet they feel the need to hike by 50 basis points with more to come. That's the reality facing the central banks. And the Fed is still, oh, we can avoid recession. We think we won't actually hit recession, a slowdown, but no recession. Come on, we're going to go into recession. Major economies are going to go into recession. If we're going to target inflation, we're going to bring inflation down. The squeeze on the consumer is significant. We're going into recession.
So why is consumer discretionary rallying this hard? This rally off the lows in June, Lee, is something else. It's up more than 20% on consumer discretionary on the S&P. Why?
Well, you've got a big split. I mean, as ever, you have a big split between sort of, you know, income levels. So lower income levels are really, really struggling with this increase in inflation. You know, a large proportion of their spending goes on food and energy, which is, you know, the heart of much of the inflationary pressure. Consumer discretionary, if you're the higher end of the income spectrum, there's still savings, there's still excess savings from the pandemic, and those are now being spent. So consumer discretionary is more that sort of higher end. Consumer staples is that sort of, that lower income end, and that's why you're seeing that divergence there.
Lee, have you already seen it priced in terms of the recession that people are predicting? And is the consumer discretionary perhaps responding to the other side of this cycle because people have gotten that far ahead?
Lisa, I don't think we're pricing in the recession that's coming. I mean, I think it's not going to be a deep recession in the same way as, you know, the financial crisis. But it's going to be prolonged. The Bank of England have told us that this morning, right? It's going to be a prolonged recession. This idea, oh, we could have a technical recession, maybe a quarter or two. No, this could be a more drawn out, prolonged recession. I don't think that's priced in. So I think that's the divergence here. And you say, you know, the massive rally we've seen over the last few weeks or so, that's not reflecting that risk. That, you know, that's reflecting this soft landing. You know, we've taken out the peak for Fed rate hikes. We're sort of looking at, okay, so, you know, that does the slowdown in growth, does the job for the Fed. They don't need to hike as far. We have this little slowdown and off we go. It's cloud cuckoo land. That's not the way this is going to play out. It's going to be a much more prolonged recession than that.
So, Lee, as you said, you've adjusted your view to become much more negative. How have you changed your allocations at a time when many people see the haven as still being longer-term U.S. bonds?
I think it still is. I mean, I think still. I mean, this is why the curve's inverted. I mean, you look at how inverted the curve is, as you mentioned, you know, the most inverted since 2000. So forget the financial crisis, forget the pandemic. This is the most inverted since 2000. And that's the allocation. You want to be at the longer end. And then in terms of FX, it's the dollar. And this is why the dollar keeps rallying. You know, the dollar's bounced, you know, the dollar weakened a little bit over the last few weeks, but it's coming back hard again now. And the Fed message is going to be clear, and that's going to lead to more dollar buying as well.
Lee, our audience has heard the same thing repeatedly over the last several weeks, and repeatedly we keep adding more weight to this rally. Lee, earlier this morning, Max Kettner of HSBC put out a note, and he's with you. He's calling this dreamland, says it's wishful thinking. At the end, though, he goes through the risk factors around the view. What if we're wrong? Lee, what if you're wrong? What's the big risk factor around your view and whether this rally can continue?
The biggest risk factor around the negative view is actually that, you know, and it would be a very positive development, and that is that the conflict in Ukraine comes to a rapid end. That leads to, you know, reduction of the sanctions quite quickly, and therefore the inflationary pressures. We can all revise down our inflation forecast. We can revise down what we expect from the central banks. That would be the risk to the view. If it doesn't end soon, it's really hard to see how central banks are going to back off, how the data is going to get better. Look, you know, we've had this from the Bank of England. I think this is a real bellwether moment with the first central bank really predicting a prolonged recession and saying, that's the way it's going to be. We're still hiking 50 basis points. I think that's a bellwether moment.
Hey, Lee, great to catch up. An important moment for sure for that central bank. Lee Ferridge there of State Street Global Markets. I mentioned Max Kettner over at HSBC. Here's the quote. For this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields. Goes on to say, but market pricing of risk assets is now very much out of line with our cyclical growth indicators. You guys have all heard that a million times. This is the conclusion. Where could we be wrong? If inflation does indeed surprise to the downside or growth stabilizes much more quickly, Tom, than we thought, then the recent rally in growth over value could continue. It continues just a little bit this morning.
The separation here, John, is like the Dallas trim mean of earlier this week, which was really quite inflammatory, or certainly what we've seen from Governor Bailey as he frames out the United Kingdom, versus those that see the goods disinflation, service sector maybe becoming quiescent, and then you easily get from, say, 9% down to 7% or 6%. The then what, to me, is a complete mystery.
So the thing I think about as I'm going through all these notes in the evening at the moment is just, Lisa, what if Marco's right? Marco Kolanovic over at JP Morgan, and what if this just continues? BNP Paribas put out an interesting note this week, and they talked about the crowding in effect. And we all know the biggest determinant of sentiment sometimes is just price. And price is changing pretty quickly. And I wonder if BNP has a point when it comes to crowding in.
And especially because if you take a look at the savings rate and you look at it across the income spectrum, at the upper ends, it still is very significant. There are a lot of people still with a lot of money who are getting pay raises and they don't know where to put it. And so where are they going to go if not just into the market? And you do see companies that are delivering on their revenues and are still growing. So at what point does that become a haven, especially in light of the inflation that might really affect some of the bonds that people are going to for safety?
John, you're going through your notes in the evening?
In the evening, what do you do?
I was watching Padres last night, 9-1,
you're always, someone's
5 in a row.
Someone's got to rate.
I'm reading.
Lita does a bit of your reading, I do a bit of your reading.
That was so exciting.
We put it together.
You know, it's just great.
You get to watch the baseball. Tom, it's 8
it's not
a.m.
the baseball,
in the morning.
it's the Padres.
It's 8 a.m. in the morning, late enough for great guests to come on this show. Are they out of bed at this point?
Yeah, you know,
Probably, right?
You know, probably entrepreneurial guys buying airline leasing companies, sure.
Someone like Jim Zelter.
That would be good.
The co-president at Apollo. He's going to join us next.
He bought a 747 today.
I think they did something in aviation that we can talk about, Tom.
He owns, you know, it's not every day you buy a 747.
You can talk to him about it. Tom Keene, Lisa Bramlett,
it's like
and Jonathan
Metallica
Ferro.
or something.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. A warning today from the Bank of England. It raised interest rates by the most since 1995 and said the UK is heading for more than a year of recession. BOE policymakers say the recession will begin in the fourth quarter, and they estimate that inflation may peak in October at 13.3%. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. In Russia, a prosecutor has asked for a 9.5-year prison sentence for American basketball star Brittany Griner. Closing arguments are taking place today. She has admitted having vape cartridges with cannabis oil in her luggage. There have been talks between the US and Russia about a prisoner swap. Investment banking bonuses on Wall Street are likely to plunge this year, according to compensation consultant Johnson Associates. Incentive pay for those underwriting debt and equity could plunge more than 45%. Those advising on mergers and acquisitions could see their bonuses fall by 1/4. At the 5 largest Wall Street firms, investment banking revenue fell some 43% in the first 6 months of the year. And shares of Alibaba are rising in pre-market trade. The Chinese e-commerce giant posted second quarter net income and revenue that were better than expected. Alibaba's cloud and media sales missed estimates, while sales at the China commerce segment shrank for the first time. The company says it saw signs of recovery, though, in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple fans will likely have to wait a little bit longer than expected to get their hands on Apple's first mixed reality headset to compete with Meta's Oculus. The iPhone maker had planned to reveal the new device as early as this June at WWDC and then release it later this year. But the company has been facing some development challenges related to the device overheating, camera technology, and a new operating system. That means that an intro as early as the end of this year or early next year with a wider consumer release in 2023 is more likely. The headset is planned to have super fast M1 Pro-like chips, immersive audio and speaker technology, and capabilities for media consumption, gaming, and communication. The headset will be pricey, however, and probably cost well north of $1,500. The product will be Apple's first big new bet since the Apple Watch launched 7 years ago, and it should enable an all-new class of applications and a developer ecosystem through an onboard app store. Apple then plans to use WWDC 2023 to engage VR and app developers to write software. The first headset, however, is only the beginning for Apple's ambitions in the space. The company is planning a standalone augmented reality headset as a follow-up later this decade. I'm Mark Gurman. This is Power On.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Some financial markets are indicating that they expect us to cut interest rates next year. I don't want to say it's impossible, but it seems like that's a very unlikely scenario right now, given what I know about the underlying inflation dynamics. A more likely scenario is we would continue raising, and then we would sit there.
The central bank that doesn't want to offer forward guidance spent a lot of time yesterday offering forward guidance. Neil Kashkari of the Minneapolis Fed just yesterday, together with basically everyone else under the sun who works at the Fed. Futures positive 0.06% on the S&P 500 this morning. Good morning to you all with Tom Keene and Lisa Brownwitz. I'm Jonathan Ferro. Futures up a tenth on the NASDAQ too. TK yields come in a couple of basis points. We back away on 10s to 268 on a 10-year yield.
Sterling 120.80 off Bank of England, John. Still extraordinary weaker sterling this morning.
Unbelievable. Down 0.6 of 1%, Tom, off the back of a 50 basis point hike, a forecast for a recession, and 13% CPI. Is that enough for you?
It's very good. I
Ugly.
like that. Let's go. Yeah, very good. What we've got here is earnings, but nobody cares, because when you do a transaction of this import and symbolism to Wall Street, and frankly, a recovering world from the pandemic, it is good to talk to Jim Zelter. He's co-president of Apollo Asset Management. And yeah, on earnings, but I'm going to go beyond earnings, Jim, to your new transaction acquiring the leasing efforts of the largest fleet of 747s in the world. This is the cargo business mostly of Atlas Air. How do you dive into such a troubled industry as COVID, Asia, moving cargo, and say the opportunity is now?
Well, good morning. Thanks for having me on. That's a classic Apollo transaction. We know the industry well. We've been around it for decades. We've successfully navigated it, no pun intended, in terms of a variety of other investments in the space. And it's a classic opportunity for us to use our great industry skills, our great capital formation skills, and do something we think has got a lot of fundamental value where purchase price matters. So, a lot to talk about Apollo today. That's one transaction. But very, very happy with what we've done in that situation.
Well, let's talk about the inflows. 36 billion, I think 13 billion after quarter end in a first close of your next flagship PE fund. Just going through some of these numbers. Jim, as you look at the opportunities in front of you, where are they? What can you do that the banks can't do that you're excited about?
Well, listen, as you said, Jonathan, it's a very foggy environment out there. A lot of dispersion on views on where rates and other things are going. And that's when we do well. Record FRE for us for the quarter, record SRE, capital formation, deployment, origination strong. For us, it was a great quarter in terms of, investor dialogue. As you said, 36 billion in the quarter. We closed 13 billion on our new flagship fund 10. And for us, this is the kind of markets that we thrive. When others are a bit paralyzed or markets are closed, we bring our flexible capital, our permanent capital, our ingenuity to transactions. And, I know you mentioned the Atlas Air, but for us, New Fortress Energy was a great transaction. Air France, in New Fortress Energy, basically we've been with this company for a couple of years. We've been a financing partner. They put their liquid LNG products vehicles into a JV. We provided the equity, but the bank market was shut. Typically, most folks would have to put their pencil down.
Yeah.
We really marshaled our resources and raised $1 billion for financing to have a successful transaction. So for us, these are the markets we thrive. Firm is doing extraordinary and hitting on all cylinders.
Jim, you said that the markets are closed, and they were for the most part until last month, where they reopened with a vengeance, and you saw everybody flood back to the market, money pile into even the most speculative debt, people basically sounding the all clear sign. What do you make of that, and how do you sort of adjust your view than perhaps in May when you said that recession was 1/3 to 2/3 of your base case, and you were talking about not taking that duration or liquidity risk?
Yeah. I think you got to differentiate between a rally in credit and the markets being open. The reality is, and it's been well publicized, that a lot of financing commitments have been hung, if you will, nowhere near what they were in 2008, probably 80 billion plus or minus versus the 400 to 500 billion. But new financing commitments are very challenging to secure today. We're a leader in private credit. We extend credit. We borrow in those markets as well. But the reality is the IG market's open, but the lower quality high yield markets, still very few transactions are getting done. Very few new commitments are being made on buyouts. So it's not as clear as you said. Again, please don't differentiate a rally in credit versus really an open, thriving financing market.
Jim, can I ask you what you think of that rally in credit, though? 140 basis points of spread tightening on high yield in the last month alone. We've got guests lining up calling that wishful thinking. What do you call it?
Yeah. Well, it's interesting. We typically, when spreads go to 600, that's a buy signal for us historically. They were there for just a short period of time. As you said, they've rallied dramatically. It feels like the rally, I would say they're on the richer side of fair value than they are the attractive side of fair value. But I think it's interesting to contrast that to the private markets right now. You can, a year ago, high yield indexes were in the mid 4s, maybe touching 5. You can be part of a senior club in private credit right now with spreads, SOFR plus 650, which is basically almost touching 9.5%, 10%. High quality first lien position, top of the capital structure, 30, 40 LTV. So that's an interesting marketplace. And we're open. We've been active at Apollo and at MidCap. The generic on the run high yield market, not particularly interesting. And I suspect you're right. Lisa mentioned, I was of the view that, a recession was in the cards in 23.
Yeah.
We still believe it will be. I don't think it's going to be a deep historical recession. As we all know, the numbers right now, you're having, negative GDP numbers with 400,000 new employment per month. So it's not your father's recession by any means. It's a different kind of environment. But from our perspective, if you have the ability to navigate, it is quite interesting, as many are on pause.
Jim, I've got 20 seconds to squeeze this in. This is the question where the person behind your camera starts waving their hand saying, don't answer it. You were considering helping Elon Musk finance that Twitter bid. Given how it's fallen apart, has that left a bit of taste in your mouth around doing business with him potentially in the future? Just a yes or no, your thoughts on it?
We're a big player in the global financing markets. We finance lots of folks. We're very thoughtful about what we do. And we got a long-term track record to prove that out.
Everyone in that room is going to be very happy with that answer, Jim.
He read that off a cue
I'm sure
card.
they had it written down.
John, Zelda read that off a cue card like Powell does at a press conference.
Good job.
Hey, Jim, thank you. Fantastic to catch up with you. Some insight there into the credit markets and beyond. Jim Zelda there of Apollo Asset Management from New York City. Jobless claims in America up next. Futures positive 0.1% on the S&P 500. We're up about 1/10 on the NASDAQ too. Yields come in 3 basis points, 267 on a 10-year. Mike McKee, ready to break down the data. We'll do that next. This is Bloomberg.
Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Economic data in America about 8 seconds away. Live from New York City this morning. Good morning. Futures positive 0.1% on the S&P. On the Nasdaq, up about 0.2% now. Yields are lower by 4 basis points on a 10-year to 266.66 on a US 10-year. With some data in America, here's Mike McKee.
Good morning, John. Well, it is the same story with jobless claims that we've seen the last couple of weeks. A small rise, 260,000. The number last week was 256. Now, that's not the revised number. The revised number we're waiting for to come up here in just a second, and we'll see what that was. The trade balance comes in lower than forecast at $79.6 billion, down from 85.5. The forecast was for 80, pretty much flat. So that is another addition, since that's a June number, to second quarter growth, which is not a bad thing. We're down 5,000, a decrease of 5,000 in the jobless claims numbers last week. This week, we are waiting to see where we come up with the new number in terms of what the change was. Now, the important number here is becoming different. It's going to become continuing claims from now on. We want to know, if you lose a job, are you getting a job with all of these openings? And we do see continuing claims rise to 1,416,000 from 1,368,000. So an increase there. That's a trend to keep an eye on, because with all the job openings that we have, in theory, the Fed's theory is that if you lose your job, you can get another one. So we will watch continuing claims, how many people are still getting claims. Now I got this number. Last week, 260, they revised it to, so 254 rather. So now it's an increase of 6,000 from the previous week.
I want to talk to you about your tip point. With all your years of experience and that you've had more meals at the Pioneer Grill at Jackson Hole than anybody I know, I want to know your tip point on claims. Is it 280, as we heard from guests this week, or is it a higher number, a more tense number from you?
I think it would be a higher number, but the other thing I would say is that I would be watching the continuing claims now, because if we do see people lose jobs, and this is the Fed's theory, if we see people lose jobs, there's so many job openings, you can probably get another job. So we'll keep an eye on the labor force and whether or not people who move into unemployment are moving off again relatively rapidly.
Mike, just quickly here on the trade balance, because this is something that I've been looking at in terms of the shipping costs that have gone down dramatically, especially for the United States. How much is this all just a foreign exchange influence that basically that is a disinflationary force where the U.S. is able to export a lot more in dollar terms based on the adjustments there?
Well, it's interesting, Lisa, because what we're seeing is a larger percentage rise generally in exports than imports, which is not what you'd expect on a foreign exchange basis. So at this point, that's helping the U.S. bring down its trade deficit. Have to see why that is and whether that's going to continue. We have, I know, seen more Boeing shipments, and those are very expensive than people had anticipated. So it could be something involving transportation, but it is kind of interesting. Last month, we saw a big drop in imported cars into the United States. Nobody can build them, whether they're in Canada or Mexico or the U.S. So that may be what's accounting for part of that as well.
Mike McKee, thank you. 260 is the number then. The previous number, 254. That's your revised number, 254. Claims heading in the wrong direction then. Very subtle move, though, up about 6,000 over the week. On the week. Futures right now, up 0.1% on the S&P. Tom, on the Nasdaq 100, up a little more than 0.1% as well. So we grind out another morning of gains, potentially. Yields lower by 3 or 4 basis points on a 10-year.
And John, but very importantly, look what 210s does. It gets right down to the pre and Misra mark. I mean, there we are, 39 basis points.
There's your move, Tom.
I mean, it's just simple.
It's a big move.
Inversion.
And when Priya said this on this show a number of weeks ago, Tom, it sounded pretty out there.
More inversion.
Here we are.
We begin our jobs coverage now. We do it with our great Michael McKee, and then we move to Thomas Porcelli. Tom Porcelli is chief U.S. economist at RBC Capital Markets, and first came to my attention with absolutely brilliant study of the wage dynamics of the United States of America. Tom Porcelli, good morning. I want to talk to you about what we just heard from Professor Blanchflower at Dartmouth, where he said basically a linkage of these tumultuous times into wage growth is unfounded. Give us your update on America's wage growth in this 9% inflation we're facing.
I completely agree with his assessment. I think that people that are comparing today to the 70s/80s, I think that they're doing us a disservice. I think that this probably has much more in common with the 40s than it does the 70s. I don't think that this is some wage price spiral that the Fed is trying to or can impact. And I think that that effort will bear very little fruit. I think the Fed is hiking pretty aggressively into an economy that's very clearly slowing down. I don't know how that ends well. I think, you know, if their thought process is, well, we got to really tamp down on wage pressures, I don't know how much more you want to tamp down on those. I mean, in in real terms, they're deeply in negative territory. I mean, I always sort of marvel at the idea that I think very few people appreciate that disposable personal income nominally, in nominal terms, from the beginning of the year to today, is really up only modestly, nominal. But in real terms, you're deeply in negative. So that whole idea, I think, is sort of foolish. And I would say one last thing, Tom, and then I'll stop. You know, this idea, and Mike McKee was talking about this a moment ago, you know, he's right. The Fed keeps on sort of, you know, hanging their hat on the idea that there's, you know, people can find a job really quick and et cetera. And make no mistake, in certain industries, that is still true. But job openings are not the thing we're supposed to be hanging our hat on. It's a massive lagging indicator. They fall in earnest in the midst of a recession. In other words, they're a free option for companies. And we're already seeing them slow now in a more meaningful way. So, you know, this idea, and by the way, sorry, one last thing on that. This idea, too, that there's, you know, 2 job openings for every person unemployed, that is not correct. You have to look at people also that are not in the labor force that want a job, right? A completely separate metric. And when you add that to the number of unemployed, what you actually see is that the ratio is actually 1 for 1. And actually, just to be clear, it was 1 for 1 prior to the most recent job openings number. Now it's less than that. So I have no sympathy for that view in any way.
So Tom, translate that picture into what we're expecting tomorrow with the jobs report that we get out there and the anecdotal data that we're getting from a number of companies that they are starting to cut back workers.
Yeah, Lisa, I think that's exactly right. I mean, you know, again, you know, I know you guys were talking about jobless claims, what number starts to scare you. I don't know why you're not scared now. I mean, it's, you know, you don't have to wait for some magical 280 or 300. I mean, you're up from 166,000, right? That was the low that we hit in mid-March. And so from that point to today, we're now up 50%. Now, I know the standard retort on that is, hey, you know, but we're coming off of really low levels. Okay, you were coming off of really low levels in 01 too. I mean, they were historically low then, but hey, we managed to actually lose jobs and the unemployment rate wound up rising. So the level thing is not compelling, it's the move, right? It's the delta. And the delta is incredibly compelling. You're up 50% from the low. And sorry, just to be clear on that. So if you look back to every recession, we went back to the recession that started in 1969. If you look at every recession, from the low into that recession, you're up about 30%. Here we are up 50%. And yes, I know there's some seasonal thing, I get all that, but even if you adjust for that, you're still up wildly. I mean, it's not a good outcome.
A lot of people would argue that you're coming from a point where everybody had been taken out of the workforce and then brought back in this sort of artificial breach as a result of the pandemic and the global economy shutting down. As we look forward, is your argument that the Fed should look through this and stand pat, not raise rates that much or at all, and sort of wait to see what happens, even in the face of 9.1% headline CPI?
I have a lot of sympathy for lifting rates. I think, you know, look, and you all have heard me say this before. I mean, I think the Fed was very, very late to this. I mean, I would argue that today we should be 100 basis points higher because the Fed was much more aggressive, you know, sort of late last year. But so I do have a lot of sympathy for that. I just think that we have to be careful and ask aloud, do you think that these interest rate hikes are actually going to scale back on inflation? I think inflation is going to slow organically. I know that's a tough pill to swallow for the Fed, and I know they can't stand idly by and wait for that to happen. So they have to keep on raising rates. I just think we have to be careful about the level of rates that we get to. I don't know that we have to get wildly into restrictive territory. I mean, look, let's be clear. You know, prior to things starting to turn pretty squishy over the last few months, the backdrop did not need any accommodation. I mean, we should have been at neutral a while ago. But I think now we're in so many ways, I feel like we're fighting yesterday's war on inflation. And moreover, I would add, there's certain components of inflation that have been doing some pretty heavy lifting that the Fed has zero ability to control, whether that's food or energy, things that are obviously now receding to some extent. But I think about some of the inflation components over the last month or two, like auto insurance or car repair. I know that might sound like these small little things. They added like a tenth, right? They added a tenth or more to the headline, to the month-on-month gain. That's an enormous number that, again, the Fed has no ability to control. People went out and bought a bunch of used cars. They are breaking down and they need more insurance. I mean, what can the Fed do about that? So I just think the Fed has to be honest about the things that it can and cannot control.
Tom, I want to finish up with this.
Yeah.
The Federal Reserve and where Fed funds peaks. Where does it peak for the team over at RBC?
Yeah, so we think you get to the midpoint would be 3.375. So basically, they hike over the balance of this year. We think that that's reasonable still at this point. I know it's probably sort of in line with what the market is saying. I don't know if I like that or not, but that's where we are right now.
Hey, Tom, it's awesome to catch up. Thank you, sir. Tom Porcelli of RBC Capital Markets. TK with some strong thoughts on jobless claims. Heading in the wrong direction over the last few months.
Well, it's a trend. That's all there is to it. And, that'll play out. But far more important is the jobs report tomorrow. Are we all three here for the report tomorrow,
We
Jim?
are in for payrolls. Lisa and I are always here.
Oh.
It's you that's questionable at times on Payrolls Friday. You're going to be here?
Yeah, I'm going to be here.
Looking forward to it.
I'm not going beige suit, though. It's a serious day.
You'll prep for tomorrow. No baseball, right?
Today was not a serious day.
He's not taking today seriously at all.
The tang will be stronger.
No, because it wasn't Jobless Claims Thursday.
Yeah.
When the man from Del Monte walks into the studio to cover markets, I question how serious he is.
Yeah.
Coming up in the next hour, you asked for that,
tomorrow,
you know you did. Troy Gajewski of FS Investments in the next hour, alongside Chris Harvey of Wells Fargo and Rubber Banks, Jane Foley. You're impossible to ignore. You know that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Bank of England is warning that the UK is heading for more than a year of recession. That came today as the central bank raised interest rates by the most in 27 years, a half percentage point. BOE policymakers also estimated that inflation may peak in October at 13.3%. And in the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in that race to become Prime Minister. Truss received the backing of former Chancellor Sajid Javid. That is a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. And Amgen has agreed to pay $3.7 billion for ChemoCentryx. It's a biotech company focused on developing drugs for autoimmune diseases, inflammatory diseases, and cancer. Amgen will pay $52 a share in cash. That is more than twice ChemoCentryx's closing price on Wednesday. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think 9%, we're kind of trending around 9%, maybe 8.8 for the next few months. By year end, somewhere around 7%. But the year-on-year comparisons get much easier next year. And that's the key. And you don't need outright price declines, right? The levels don't have to decline. Just the month-to-month change has to slow.
Kathleen Bush-Johnson, she was absolutely lights out yesterday, Lisa, with Oxford Economics. I just thought she was great, piling into this jobs report tomorrow.
Yeah, and it's really an interesting moment when there are a lot of people saying that this is the key indicator the Fed will be watching to determine how quickly they can back away from some of those rate hikes that they've basically forecast.
Sterling with a little bit of a rebound, a 120 up to a 120.105, but still the shock of the Bank of England meeting. We've got the claims report coming out, U.S. futures up 7, et cetera, but also the churn in Washington. And there's so many themes we've covered this morning. Right now, we are advantaged with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. And Greg, I really want to go to the broader tone. I want to go away from what I read in the Washington Post and the great Bloomberg politics people to the senator from Wisconsin who was talking up like he owns the high ground. And Ron Johnson beat Feingold, the Democrat, by 50.2% of the vote the last time around. And Ron Johnson's coming out with statements that you and others would suggest really cause risks to the Republicans.
Well, I tell you, Tom, this has got to be Mitch McConnell's worst nightmare. He's got some bad candidates in Georgia, Pennsylvania, Ohio. They have overdone the abortion issue, which I think has backfired on them, as we certainly saw in Kansas. And you're right, Tom. Here comes Ron Johnson of Wisconsin, who says yesterday, maybe we have to change the structure of Social Security, make it something that has to be renewed every year, which would be a nightmare, of course. People would use that as a hostage for other legislation. I mean, are they trying to blow the Senate election this fall? I mean, the House is going to flip to the Republicans. I think that's pretty likely. But all of a sudden, the Senate is very much in play, and Johnson is a factor in this.
Is there a middle ground for Republicans? I think with Taiwan, we saw that with Mr. Romney maybe taking a different tack than Rubio and other Republicans. But can McConnell and the Republicans find a middle ground that can salvage their Senate election?
I think so. There are an awful lot of Republican Senate candidates who are saying they would not support Mitch McConnell for another term as the leader of the Republican leader of the Senate. So it's a very, very divided party right now. And I think this is a shocker to all of a sudden see 3 or 4 or even 5 Republican seats look shaky, and maybe only a couple of Democratic seats look shaky. In a 50-50 Senate, the Democrats have a path to keep control.
This comes at a time, Greg, where the Democrats are trying to push through the Inflation Relief Act of 2022, the reshaped Build Back Better bill, and reframed in a new way for a new moment. How much do you view this as a likelihood, and how much do you view this as actually helping the Democrats heading into the midterms?
Well, I tell you, Lisa, all of a sudden you've got to conclude this bill is in trouble. Some provisions are going to have to go. Kyrsten Sinema, the moderate Democrat from Arizona, does not like anything on carried interest. I've been joking that carried interest is like Rasputin, cannot be killed. And it looks like this may wind up staying in the bill. She also, I think, has problems with the corporate minimum tax of 15%. So I think the bill is going to have to be rewritten to a certain extent. They were planning to leave tomorrow in the Senate. That can't be done in hoping to get a bill. It could be after Labor Day before a bill is done. And I think the bill could get even smaller.
There's a broader question here about the ability of this Washington to take fiscal action at a time of inflation as we head into a lot of what people are saying is going to be a recession. You see this over at the Bank of England, that they are hiking rates today. There is an expectation on the fiscal side there will be aid to offset the pain from that felt by the consumer. In the United States, is that kind of fiscal support off the table because of the politics right now and because of what the spending, how it was perceived during the pandemic?
How is this for an irony, Lisa? You've got very restrictive monetary policy now and restrictive fiscal policy just as we come close to a recession when maybe you could use a little stimulus. So, yeah, I think that the mood in Congress is to not spend much more money.
Greg, one last question here. We've got so much going on today. What is the legacy that Speaker Pelosi earned from this trip to Taiwan?
I can't figure it out, Tom. I don't know why she did it. A lot of people in the Biden administration asked her not to do it. I know she feels strongly about human rights in Tiananmen Square, but I think she stirred the pot in a way that was not constructive.
Greg Valliere, thank you so much. We value your notes each morning. And of course, folks, we protect the copyright of all of our guests. Look to AGF Investments Toronto and somewhere. He's in a shack up in New Hampshire somewhere. AGF Investments will get you the reports of Greg Valliere as well. Lisa, I don't even know where to begin on today. What is your thought as you look at the Bloomberg screen?
Well, just the resilience of stocks amid pretty much a consensus of gloom when it comes to the economic picture. Stocks are not the economy, and you do see an incredible bifurcation in terms of the income tiers. There was a Wall Street Journal article recently highlighting the savings rate for the lowest income, the middle income, upper middle income, and upper tier of American households. The wealthy are doing well. Their savings are being built out dramatically. The poor actually built up more during the pandemic because of the checks. The upper middle class is getting squeezed on every level, building debts, not being able to spend as much in real terms. And how does this bleed out in an economy that is really an economy of averages that really gloss over some of the nuance on
and Tom Porcelli mentioned that with the real wage or lack thereof and the scale of it, I should say, as well. I hate to do this, Lisa, but I think we've got to talk about Pharaoh's United Kingdom today. I knew it'd be a big deal, but I just simply, the language that we heard from Governor Bailey, for those just tuning in, absolutely original. You'd never see that by the Fed.
Lee Farage of State Street came on the show earlier this hour and said it was a bellwether moment to have a major central bank come out, hike rates by 50 basis points, and project a deep recession that had staying power. This shows the conundrum that banks are in as they face a stagflation type of environment. It is incredibly difficult, and it is something you're going to see in different shades, in different tones around the world.
Incredibly popular demand has forced the three of us to be with you tomorrow morning, and I have to believe it will be a more than important jobs report. Lisa, I'm going to be looking at the revisions, the look back one time, the look back two times, and adjusting those revisions into the pretty good number we're going to see as well.
I'm going to be watching wages. That gives a sense of how much pressure there is. Anecdotally, we are hearing about cutbacks. Walmart cutting about 200 corporate jobs. A number of companies have come out and talked about retracements. How much is it one-off? How much is it industry-specific? And how much do you see that in how much people are demanding higher wages and actually getting them?
And with the Bloomberg reporting this morning, perhaps a small cutback in Zurich as well at Credit Suisse. That'll be one of our themes of coverage today on radio and television. We are steeled for the jobs report tomorrow. We hope you'll join us. We'll start in strong with the usual victims with us. Looking forward to that. See you tomorrow. Alan Blinder at 12 noon today. This is Bloomberg. Usual victims with us. Looking forward to that. See you tomorrow. Alan Blinder at 12 noon today. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This market is laughing in the face of the hawkish Fed talk. Live from New York City this morning. Good morning, good morning. Another rally on our hands. We inch higher by about 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, climbing the wall of doubt.
with the rally that we've seen so far.
The big question is, okay, now what?
Well, we don't know.
Possibly going through a bear market rally, possibly starting a very real new bull market rally.
But right now it's all about earnings.
Earnings are cranking away.
We're making our way through earnings season.
This season so far has been, again, one more, really pretty good season.
A relatively solid earnings season.
Yeah, you're going to start seeing equities get supported.
But the problems are still with us.
We may or may not be in a recession.
A lot of data is still out there.
Core, headline, CPI, PC, whatever. It's all some huge number.
We're still expecting the Fed to raise rates.
Investors don't know exactly how this script is going to play out.
A lot of answers we still need.
Joining us now is Rabobank's Jane Foley, Troy Gajewski of FS Investments. Jane, first to you. The Fed was comfortable with choppy June markets. Does it hate markets in July and August?
Oh, well, I think some of the economic data has been a bit better from the US recently, or certainly if you look at yesterday's numbers. And of course, those earnings seasons are higher too, but, the fundamentals remain the same. That the Federal Reserve, the commentary that we've had this week suggests that the Fed is going to be still pretty aggressive in terms of getting inflation down, acting on policy, trying to get those inflation expectations down to stop those second-order inflation effects. So I think the equity market rallies are still quite brave in this environment. I still think there's an awful lot of negative news still to come from interest rates, particularly.
The performance off the June lows, Troy Gajewski, has been phenomenal. Up almost 20% from the lows of June on the Nasdaq 100, up around about 13% on the S&P. Consumer discretionary, I keep going back to that. It's up about 25% from the June low. Troy, I'll ask the same question to you. Why are market stocks laughing in the face of this Fed speak of the last week?
Well, look, bottom line, sentiment was very negative in June for very good reasons. Not only a slowing economy that with recession risk going up substantially, but also a Federal Reserve that, as you know, is going to tighten aggressively, already has started that. But bear market rallies are classic attributes of bear markets. When you look back at history, you typically had the strongest rally in bear markets where you get marginally less bad news. In this case, it was, markets really grasping at the new concept of neutral, being close to neutral in the last Fed announcement by Powell or discussion afterwards. But the reality is markets are laughing at the Fed right now, and the Fed has a tough job because they have to tighten financial conditions. When we look forward, we're hopeful that CPI can get to 7% by the end of the year, maybe a smidge lower. That's obviously unacceptable. The looser financial conditions are, the more it steals the resolve of the Fed to tighten even more aggressively. And John, maybe, just maybe, the month of August, they'll actually hit their QT target finally and start getting more aggressive with the balance sheet drainage.
Yeah, I've had a lot of questions about that privately behind the scenes as to what is actually happening with that balance sheet. Jane, for a central bank that doesn't want to offer forward guidance, they've offered a lot of forward guidance over the last 24 hours, haven't they?
It would certainly seem that way. And it's quite interesting because the lack of forward guidance seems to be the topic that several central banks are going down. You could accuse the RBA, certainly the ECB, of not wanting to produce forward guidance in the same way, making policies data-driven. But certainly, if we look at the Federal Reserve commentary from the start of the week, it has been hawkish, and there has been a fairly large amount of candid outlooks from some of these federal bank members. And what are the markets taking away from that? Well, they've taken away from the fact that 75 basis points could still be coming again, maybe in September. It's not totally out of vision for that. So, markets, I think, are preparing, certainly in the bond market, for maybe more in terms of interest rate hikes. And I think equity investors, need to keep an eye on that.
Equity investors confronting right now a wall of doubt and climbing over it with ease. Every single note I read is saying the same thing at the moment. Here's the note from Goldman and Goldman Sachs' Cecilia Mariotti. She says, without clear signs of a positive shift in macro momentum, temporary re-risking could actually increase risks of another leg lower in the market rather than signal the end of the bear market. Over at HSBC, Max Kettner wrote this: for this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields, but market pricing of risk assets is now very much out of line with our cyclical growth indicators. Barclays joins the party. The emerging Goldilocks narrative for equities is that bad data and peak inflation will prompt more dovish central banks. We are skeptical and would fade the rally. We're bearish. Sentiment positioning can extend the short squeeze. Troy, what if the bulls are right? Can we just consider that for a moment? What if Marko Kolanovic over at JP Morgan is just right, that the peak story is in, and from here it's about recovery for this equity market?
Well, I hope he would be right now instead of coming into the year when he was wildly bullish. But look, there's always a non-zero probability that the fundamentals or all the fundamental analysis is wrong, right? When we look forward, the only thing we can think of, and there's very few, is that, remember, nominal GDP is growing much, much faster than real GDP. Revenue comes in nominal GDP. Margins are compressing, but are they going to compress fast enough into a slower economy to lead to meaningfully lower earnings? We think we have the answer in a recession. Obviously, earnings are going down. The question is to what degree. But if the Fed can thread the needle and nominal GDP dwarfs real GDP enough and margins don't compress substantially, that could in fact mean we hit at least a local bottom in June, but it's still highly, highly unlikely we've hit the bottom of this incredible bear market that's primarily driven by exceptional inflation and very aggressive Fed tightening, and now, unfortunately, a much, much weaker economic environment.
And we've got an easing of financial conditions over the last month in a material way. Not just the equity market, but credit spreads in high yield have tightened about 140 basis points in a single month. In the same month, they were all discussing more rate hikes and potentially a recession in America. Go figure. Futures right now fade a little bit. They're positive by almost a tenth on the S&P, up by a little more on the NASDAQ. Let's get to Taylor Riggs for a little bit more on this market jittery phase for the investor base. Hey, Taylor.
And some easing of those financial conditions, John, when you take a look at the last few weeks and the rebound that we've had within the equity market as well, despite, as you also mentioned, a huge lift up, back up in yields earlier this week. Again, sort of a 20 basis point move, and then a little bit of an additional lift yesterday, at least on the front end of the curve. So in the last few weeks, you've had some significant gains in terms of equities higher and bond yields trying to find their footing here within a 10-year yield. When you think about the bottom, John, and I love that you were talking about some of the bullish notes out there, is how much of this relates to sort of the bottom line and coming out of earnings season? There was a great note out this morning that we're still 6 to 7% higher in terms of earnings per share than we were at the January high. So a lot of people are saying that we still have a lot more room to run. This is actually more just a big bear market rally, because in previous recessions, you really need to start to see those earnings per share really start to come down, and we are nowhere near there. When we think about some of the positioning, look at the terminal chart. I think it was interesting. The AAII survey had sort of signaled this as well. You're a little bit higher on the week, but still looking at 18 straight weeks of sort of the bearish positioning, and this highlights this here as well, right? Sort of how we're thinking about sort of our outlook here. Some of the bearish levels that we haven't seen now actually going back since 2016. John.
Taylor, thank you. I want to come to you, Jane, just on some of the economic data, away from some of the market stuff. Yesterday, S&P Global had a PMI for services. It was terrible. We ignored that. We focused on ISM services, which was great. Why is that, Jane?
Sometimes the market sees what it wants to see, and then certainly if the market was, in the appetite for buying a little bit of risk, then it would have probably focused on that. But ultimately, I think the data will come out in the wash. Everything that is in there will eventually run through. And I think, generally speaking, if we step back, the market is looking ahead to slower growth for the US into next year, and of course weaker growth globally as well. From China, from the Eurozone, and certainly, of course, from the UK. So, this is not an infrequent thing to happen, the market focusing on what it wants to see. But again, it's part of perhaps a short-term outlook rather than, looking in the big picture.
Jenny, are you expecting that ISM to come down to where that S&P Global PMI ultimately is? Is that how that gap closes from your standpoint?
Yeah, that eventually does happen. I mean, we can see that in lots of bigger surveys. If you look, for instance, in, the various measures of labour, eventually when we stand back, we wait for all the revisions to come through, then they generally tell the same sort of story. And I think given that the Fed has been hiking, given the strength of the US dollar, given the early signs that we've seen of labour market loosening in various different indicators, I think that's exactly what will happen.
Troy, no real sign of a Fed pivot. The data's weaker. I'll catch up with Mike McKee in about 5 minutes' time. We'll talk about jobless claims. They're heading in the wrong direction. I've asked a few guests this question, Troy. I'll ask it of you. What business do high-yield spreads have tightening 140 basis points in a single month?
Yeah, unfortunately, very little business unless we can avoid a recession. If the Fed can thread the needle, perhaps we've seen the wides and spreads this cycle. Although, again, if you look at what the Fed is forecasting for balance sheet drainage, it's 4.5 times the pace of the last QT, 3.6 times in terms of nominal GDP, and 2.9 times in terms of existing money supply. So that alone, we think, should drive wider wides and high yield. But clearly the tightening, back to your positioning discussions before, just alongside equities, we had extreme bearish sentiment. There hasn't been a lot of new supply, which over the medium to long term is obviously tough for the economy, but it means you could set up for a bear market rally there. And John, you know what happens in recessions. You know, high yield goes to 1,000 to 1,200 over. It obviously got meaningfully wider in the GFC and the pandemic, but no one's calling for that. So in a recessionary outcome, clearly high yield spreads are going wider.
Well, the Bank of England is forecasting a big recession over in the UK, starts Q4 and goes through the whole of 2023. Jane, first question I asked myself when I saw these forecasts from the BOE this morning, 13% inflation, recession from Q4 this year through next year. Can you imagine the Fed forecasting the same thing, Jane? What did you make of that?
No, it's incredibly candid from the Bank of England, incredibly candid language that we don't generally get. Sometimes you get this candid language from the Riksbank, sometimes from the Aussie or the RBNZ, but generally not from the Bank of England. It is very worrying to see the data that they're talking about, a 13% print on inflation by the end of the year, and then several quarters of recession. For many UK economists or many UK watchers, though, it's not an enormous surprise. There's been a lot of very gloomy indicators already from the UK, and I think one thing's for certain is that the UK is sort of further into the growth slowdown phase of the economic recovery than other G10 nations. We've had for a while, you know, the forecast from the OECD that the UK economy will perform the worst in the G20 bar Russia. No growth at all, it's forecasting for next year. So a lot of the gloominess is in the price, but it's still quite startling to see this sort of language from the Bank of England today.
I've heard some people say they're just being more upfront and honest about what they think is going to happen in the future. Jane Foley, Troy Gajewski, they're going to be sticking with us. I want to get you some movers ahead of the opening bell. Futures slightly positive. Here's Abby with more. Hey, Abby.
Hey, John. Well, those futures are slightly positive, ever so slightly, but we've got bigger movers beneath the surface. Starting out with the shares of Cigna, they are popping sharply higher this after the insurance company put up a better second quarter than expected. They also raised the 2022 operating profit outlook as non-emergency medical procedures. They're not happening as much, so it brings down the company's expenses. ConocoPhillips up 2.4%, a better second quarter, similar to Chevron and Exxon, and despite guidance for higher costs, they are boosting buybacks and offering a higher dividend, investors liking it. On the downside, though, Lucid Group, the luxury car maker, plunging down more than 12% as it halves its EV production targets for a second time this year to 6,000 to 7,000 vehicles produced this year from the original of 20,000. Somewhat related, just crossing the tape now, Nikola, they put up a better quarter than expected. That stock popping by 5%, and then Toyota down 3%. They are sinking. That stock is sinking, John, after the company said it is sticking with what is considered to be its conservative profit outlook.
Abby, thank you. In the commodity market, we've got a break of 90, 89 and 92 on WTI. We're down 0.8%. That's a break below $90 a barrel on WTI for the first time since the invasion of Ukraine. Crude breaking down on Brent, we're down 1% to 95.75. Coming up, Fed officials doubling down on their pledge to curb inflation.
Whether we are technically in a recession right now or not, it doesn't change my analysis. I'm focused on inflation.
A lot of forward guidance from a central bank telling you they're not going to provide forward guidance. That conversation up next.
record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. This week, will we see the first cracks in the labor market?
There's another shoe out there to drop.
Will the labor economy break?
Can the Fed deflate the demand for labor in the economy without pushing up unemployment?
This Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
We still have a lot of slack in the labor market.
The labor market is going to be seen as to whether it keeps the light green on go, go, go for this Fed.
The July Jobs Report, Friday on Bloomberg Television and Radio.
We are laser focused on getting inflation down. And, whether we are technically in a recession right now or not, it doesn't change my analysis. I'm focused on inflation and where inflation is likely going. And that to me is what we have, my opinion is what we have to focus on right now.
That was Neil Kashkari, the Fed president over at Minneapolis, just one of the many central bankers over at the Fed, pushing back against the policy pivot this week, focusing on inflation even at the risk of recession with less than 24 hours until the payrolls report here in America. Let's get to Mike McKee for more. Hey, Mike.
Hi, John. There's an old saying, don't fight the Fed. Is anybody listening to what the Fed is saying these days? You take a look at the bond market and you see what's happening with 10-year yields. They've gone down, and that pulls down the blue line, which is the financial conditions index. So as the Fed tightens, we're seeing conditions get looser, and they're way below the yellow line there, which is where the Fed says its base rate is going to be at the end of next year. So what's going to influence the markets? Well, we have a jobs report tomorrow that people are talking about. It is supposed to slow to 250,000. Will people take that as bad news? The 5 years before the pandemic, the average on a monthly basis was 193,000. Unemployment averaged 4.4%. We're at 3.6% now. So there's some room to give where the Fed could bring it in for a soft landing, but right now the markets are not believing that. Take a look at this number here. This is claims, and this is the jobs number, job creation number, and the claims, the CPI number rather, and the forecasts for both. And you can see that we are expecting inflation to go down, but jobs to stay steady, which is also good news for the Fed, but does not tell you why the market is doing what it's doing and pricing in a recession still.
Mike, I'm going to squeeze this in. People throw this question around a lot, so forgive me for throwing it around this morning. Is the Fed losing control a bit here?
Let's say the reins have loosened a little bit. The question is, do they come back? And that'll depend, as you say, on Fed speak, especially Jay Powell at the end of August.
Mike McKee, thank you. Payrolls tomorrow, then on to CPI next week. Two big data points for you over the next week. Right now, futures negative 0.1%. Then the question we're all trying to answer, is it too early for the labour market weakness to show up from the weakness elsewhere? Do we see the weakness elsewhere bleed into the labour market? Do we see that as soon as tomorrow? Matt Lazzetti at Deutsche Bank says this: I do think there's a potential for labour hoarding. That could mean that we don't see the effects in the labour market take place for a longer period of time. The view from Deutsche Bank there. Jane Foley, can I put that question to you? Do you expect the recent weakness we're seeing elsewhere to bleed into the labour market anytime soon?
Well, Well, because we all know that the labour market is a lagged indicator. Hoarding is one reason, and also if we look back at for years, not just because of the pandemic, we've seen the amount of people in the labour force in the US has really dropped away. So that's another reason why firms might want to hoard. They might think, well, it took us ages to get back up to speed after the pandemic. We don't really want to allow these workers to go too easily. So yes, there is good reasons why economists see the labour market as being lagged. That said, if we look at initial claims already, there is a little bit of sign of loosening. If we look at the household survey, if we look at some of the indicators within the ISM survey, we can see a little bit of loosening in the labour market coming through. So I think we will see some, but perhaps, it's still going to be a pretty firm labour market overall in the next few months.
Troy, what do you reckon?
Yeah, well, look, clearly the labour market's starting to soften. The good news is, though, it started in a white-hot zone and has drifted to red-hot and now arguably to hot. And that's the main reason we haven't had worse economic outcomes so far, right? I mean, you look at every component to GDP was negative in the first half. You look over at Europe, Europe's obviously a disaster. China's a mess. The U.S. consumer has single-handedly been keeping the global economy afloat. Unfortunately, if you extrapolate the recent labor trends forward, and we get 200 basis points more of unemployment from where we were recently, it's almost impossible to figure out how we don't have at least a mild recession. And, every data series we look at, particularly withholding tax growth and other factors on the tax side, which are more real time, points to a labor market that's softened significantly. And eventually it's hard for the U.S. consumer to do it single-handedly.
I asked Mike McKee whether the Fed was losing control. Jane, there's another question we should ask too, whether they're seeing what they want to see. Because jobless claims, yes, are climbing. We're taking some heat out of the labour market. I think that's very, very unfortunate, and we all agree with that because no one wants to see job losses. They want to see job openings come down. They wanted to see inflation come down, crude south of $90 a barrel on WTI. Jane, can you help me understand the distinction between the things that are developing at the moment that the Fed doesn't want to see and the Fed and the things that they're actually shooting for, the objective?
Well, we've got to remember that monetary policy is an extremely blunt tool. And clearly, we all know that a lot of the inflation is supply-driven. Not all. There are a number of instances of strong demand, particularly in the US. And in fact, there was a back-of-the-envelope calculation from the Federal Reserve in the middle of July produced to say that demand, because of fiscal spending during the pandemic, reduced US inflation by something like 2.5 percentage points, really quite significant and more than elsewhere. So we know that we've had excess demand. The Fed can't control the supply side problems. It can control the demand. It's going to bring down demand. And yeah, okay, it would rather people remain in their jobs and job openings reduce. But the reality is that it can't fine-tune the economy like that. The reality is that it will make the labour market worse. And that's part of the pass-through of monetary policy to slow the economy, to bring equilibrium in supply and demand down to a lower price level, to bring inflation down. So inevitably, I think, and purposely, the job market will loosen in the coming months.
Jane Foley, Troy Garsky, to the both of you, thank you. Coming up on this programme, the morning calls, and later, from Bernstein to Goldman, sounded the alarm on the recent equity rally. How many banks are doing that right now? Chris Harvey of Wells Fargo is going to join us in about 7 minutes' time. Looking forward to that. It's just around the corner.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Live from New York, equity futures slightly negative, down 0.1%. Good morning to you. That's the price action. Here are your morning calls. Cowen downgrading calls to market perform, expecting a weaker and inflationary backdrop to drive EPS downside. UBS upgrading Southern Company to buy, seeing fresh growth opportunities after winning approval for its long-awaited nuclear power plant. And finally, Bear downgrading Under Armour to neutral, $10 price target, highlighting a challenging macro environment and poor earnings visibility. Coming up next, we'll catch up with Chris Harvey of Wells Fargo and why he thinks that weakness in corporate earnings isn't going to come until next year. That's next. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
25 seconds away from the opening bell in New York this Thursday morning. Good morning to you. Here's your price action. Slightly negative, down by 0.02% on the S&P. On the Nasdaq, totally unchanged after ripping almost 20% off the lows of the middle of June. What a rally we've seen on the Nasdaq 100. That's your opening bell. Switch at the board and get to the bond market. All over the place. Yields lower now by not even a basis point to 270.28, much higher at the front end. Curve inversion, 2s versus 10s on my screen, about negative 38 basis points at the moment. The euro showing some strength, euro dollar 101.84, and crude showing some weakness here. We're down more than 1 percentage point. It's a break of 90, 89.57 on WTI. About 15 seconds into this, let's get you some movers. Here's Abby.
John, let's start out with one of the big winners yesterday. Today, not so much. Of course, I'm talking about Meta, and we heard yesterday about the possibility of a bond offering. Well, it's now a reality. This is the company's first ever bond offering. It will come in 4 parts, and it could be as much as $10 billion. And actually, now you have the stock flipping ever so slightly higher. Alibaba soaring, though, up 6.3%. Sales were better than feared, a big beat for the company relative to low expectations. This despite a contraction in the Chinese economy. To the downside, though, Eli Lilly down 1.5% off of its pre-market lows. They missed second quarter revenue estimates. They also slashed the fiscal year adjusted earnings forecast. Looks like it's a combination of macro headwinds and pricing. And then finally, you were just talking about oil below $90 a barrel, below important support. That's weighing on the energy complex. As you know, the worst sector on the day, and Occidental Petroleum, one example of that, down 0.8%.
Abby, thank you. About a minute and 15 seconds into this, almost totally unchanged on the S&P 500. Big tech has been leading the rebound in equity markets over the last month, though. The Nasdaq 100, as I've said repeatedly, jumping about 19-20% from its June lows. Taylor Riggs has more. Hey, Taylor.
And John Authors, of course, our Bloomberg opinion columnist, says sort of maybe nicely that if you think about a bear market as a 20% decline, could a bull market be a 20% gain off of those lows? If so, using that loose definition, what a way we have come. As you mentioned, it's been all about big tech. The New York FANG index, the SOX index, the Nasdaq 100 really now up more from some of those sort of lows that we had mid-June, now 19, even 24% or so. A lot of this, as you've been mentioning, has to do with the yield story. We've been looking at a big rebound in the equity markets because in blue, it's been yields coming down. Of course, in the last few days, maybe a little bit of that narrative has changed, particularly on the front end. But in the last few weeks, it has really been a story of yields continuing to grind lower, helping to boost some of those long duration assets that is big tech. Finally, sort of on some of an individual mover level, we've been talking in the closing bell, pins for one, PayPal, of course, given sort of the Elliott investments, but Tesla, Amazon as well, sort of some of the big movers in there. You're up 20, sometimes even 40% on some of the individual names that have been fueling sort of the big rebound that we've been seeing as of late.
Unreal. We've absolutely ripped. Taylor, looking forward to the coverage at the close. As always, Taylor Riggs there. I've talked about a long list of strategists doubting this rally. Max Kettner over at HSBC is one of them. This is what he's got to say. July's repricing higher of both risk-on and risk-off assets now leaves us with an unrealistic Goldilocks backdrop. We move to maximum underweight across equities, high yield and sovereigns, and are tactically overweight cash. Kaylee has more. Hey, Kaylee.
Hey, John. Well, they say all good things must come to an end, and a growing number of strategists, as you say, are saying that end is near for this equity market rally because, of course, Taylor was just running us through how far we've seen these stocks come off the lows, especially tech stocks. But what that has done is made them more expensive. When you look at historical PE, we are still well above that 20-year average. And Bernstein, one of the shops that is really focused on the denominator of that, on the earnings story, saying basically we're still really early in this downgrade cycle. That echoes what we heard from Bank of America earlier this week, which said, yes, we have seen forward estimates coming down, but not enough, considering they're still 6% above where they were when the equity market peaked back in January. And their data shows that in the last 4 recessions, the S&P only bottoms after EPS forecasts have fallen either to or below the level they were when the market peaked. So it's really pessimism about the forward view that is forming the bear case here, because, of course, the backward-looking view at the second quarter really hasn't been that bad. S&P earnings are up 9.7% year on year. Of course, a lot of that has to do with the outsized moves we have seen for profits for energy companies. But it's not just all about the earnings story either. You also have Goldman Sachs saying the path from here is likely to become more dependent on economic data. And without a clear positive shift in macro momentum, stocks could see another leg lower, John.
Kelly, thank you. Chris Harvey of Wells Fargo has a message to the bears. You're too early. This is what he's got to say. We do not expect to retest the lows until the first half of 23. Fed expectations toggling down, the lower cost of capital and second quarter earnings clarity has raised the equity market floor. First half of 23 may be tough for stocks. He goes on to say we may see operating margins collapse at exhausting consumer and the job pitch are turning for certain. Chris, I'm pleased to say, joins us right now. Chris, let's start there, buddy. And it's great to catch up with you, sir. Why do you think the bears are too early?
Well, again, it's exactly what we said, right? Your cost of capital is down. We're through earnings. Earnings, even for us, as we look at margins, we expected margins to not be as strong as they were. And strong is the wrong word. We expected more compression. You didn't get it. But more importantly, the thing that we always talked about, the thing that we hung our hat on, it wasn't about a valuation. It wasn't about a level. It was about the Fed. And when the Fed was going to toggle things down, what we said and what we believe is equity market can sustain gains and equity market prices can go higher. And that's what we're seeing. And the last thing you touched on, and a few of the commentators touched on it, we are now in a growth market. Rates are coming down. That's really positive for growth and for the market in general because the S&P is a long duration asset.
Chris, can that continue to work with inflation close to 9%?
All right, John. So let's talk about break-evens. Let's talk about inflation, and let's talk about what's happened over the last year. A year ago, we said this very loudly on the show a number of times. Last year at this point in time, I had never seen a pricing environment the way I had seen it last year. Everyone was raising prices, and the consumer was just price unconscious. Now we're seeing a consumer that is no longer price unconscious. They are making decisions, and they are changing their behavior. More so, if we look at break-evens from right across maturities have come down and come down significantly. So the market's saying that cyclical component to inflation is coming down. If we look at some of the components in ISM recently, they've come off the boil. What we haven't seen is CPI. CPI is still running hot. We'll see. We get CPI a little less than a week from now. But ultimately, what we're seeing is inflation come down, and we should expect inflation to come down. It will be sticky. There are geopolitical reasons why it won't get to levels that we've seen in the past. But ultimately, we're late in the cycle. The economy is slowing. Demand is slowing down, and the consumer's behavior is changing. So again, expect to see inflation come down. It'll be a little bit tricky with CPI. We'll see what happens. But ultimately, all the factors you need to see are occurring. And so we're in a much different camp with inflation today than we were a year ago.
Chris, help me out with the timing of this. And as you know better than most, the timing of anything is the most difficult part of the call. When do I start to transition away from what's working now towards what you're anticipating in the first half of next year?
Yeah. So John, what we said at the beginning of the year, we thought the first half of 2022 was going to be about defensives and cyclicality, reopening. In June, but we also said by the second half of this year, we're going to go into a growth market. We're in that growth market. In June, we downgraded cyclicality. And what we're telling clients is you really need to rinse the portfolio from cyclicality. What we're seeing on the value side is we're seeing what I consider a lot of value traps. Companies trading at mid-single digit earnings, okay? Whenever I've seen this that late in the cycle, what that is the market telling us those earnings that you see today are not going to exist in 6, 12, 18 months. You're going to get multiple expansion, but not the kind you like. So I think we're in a growth market. I think we'll stay in a growth market, but you also have to manage your risk. And there are parts of the low vol defensive sector that we do like, and you want a barbell growth with something either better balance sheets or a little less volatility.
Chris, I don't know what to do with discretionary. Can you tell me what to do with discretionary? I hear everybody talking about a bear market, a recession, and there we are ripping 25% off the June lows. And Chris, I just scratched my head at that. What are we doing?
Yeah, it's a good question because we're looking at that right now. We've been underweight retail for some time. That's worked very well, but you are seeing a balance. And we just looked at the performance of staples versus discretionary. And staples obviously have ripped over the last 6, 12 months versus discretionary. Right? And what we're seeing, getting back to margins, what we're seeing on the staple side, that's the area where we're seeing real margin pressure, right? And staples, discretionary looks like maybe it's in the bottoming process, maybe it beat the rush. So it's worth a look. We're not sure just yet, but we're going to do a lot more work in the space because prices have really turned and multiples in some cases are trading at recessionary levels.
Someone's doing more than looking. They're buying tons of it, apparently. Chris, it's good to catch up. You're going to stick with us, I know. We're going to talk about some layoffs potentially in corporate America. Consumer discretionary right now up another third of 1%, leading the gains this morning. The S&P down by a little more than a tenth of 1%. On the downside, as you might expect, it's energy down 2%, given the moves we're seeing in crude. When was the last time we talked about the 80s on WTI? We can do that right now. $89 a barrel on WTI, down 1.4% on the session. Coming up, investors gearing up for payrolls as corporate America continues shrinking its workforce.
Even though the economy is slowing down, we still have a really tight labor market, and there's still more jobs out there than workers.
Walmart's the latest. That conversation up next.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
The most fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who are making things as important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it. And I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Slowing down, we still have a really tight labor market, and there's still more jobs out there than workers. So I think it is possible to cool the labor market and cool the economy without seeing a real large increase in unemployment. There is a way to kind of thread that needle, even if we have a bit of a mild recession.
Investors gearing up for jobs day in America. This as a growing list of companies continues hitting the brakes on hiring. Beyond Meat, following Walmart, the CEO writing the following: while difficult, this decision is one piece of our larger strategy to reduce operating expenses and support sustainable growth. Taylor Riggs has more. Hey, Taylor.
And John, like you said, just in the last 24 hours, a few companies, Walmart, of course, after the bill yesterday, saying a reduction of about 200 employees. But again, for the largest private employer, that may not be a huge deal, except that when you start to add up sort of everyone else, right, and you just sort of think about the difference in Robinhood, for example, cutting to 23% of their workforce, and the shift that we've seen from slowing growth of hiring to freezes to then maybe laying people off. And that is where sort of we really start to look at this labor market. Maybe one reason, and Mike McKee, of course, would nail this more than I would, is sort of the employment cost index as we track how maybe expensive through some of the direct and the indirect costs some of these employees are. It's near sort of a record since we've started tracking this data going back since 2001. The training, the taxes, Social Security contributions, sort of you name it. And that could be maybe one of the reasons behind it. Really interesting, though, if you take a look at this terminal chart, while companies, they've been paying more, of course, for these employees, hasn't been keeping up with sales. When we think about sales per employee, it's maybe a look at some of the productivity and sort of rebounding, of course, from a trough when it was up now against about 30% from that day, John. So that can sort of track sort of where we are with this labor market.
Taylor Riggs, thank you. Going into payrolls tomorrow, looking for something close to 250,000. Mike, you know this story. We're all asking the same question. We've seen some weak data points. Will we see one tomorrow?
Well, we don't know, because the numbers that people use to try to figure it out have given us mixed signals. We just got claims this morning, and jobless claims are up by another 6,000. That's been a regular thing, but take a look at the box in the corner there. Continuing claims rising, but not nearly as much, which suggests that people who are losing jobs are still rapidly getting new ones. And as long as that's the case, then maybe we don't see a huge change. The forecast for tomorrow, you've had this up a couple times, 250,000. That is a slowdown from where we have been, but it isn't significantly so. It's much higher than average over the 5 years before the pandemic, and no change expected in the unemployment rate, so it doesn't look really bad. And also, the one thing I got to point out here is that jobs are not a great recession indicator. By the time we get to a contraction in jobs, we're already in recession. You can see that clearly in the chart, and nobody predicts a contraction in jobs before it happens. So it's hard to say that this is going to be a huge leading indicator, but it will tell us something about the health of the economy overall, and then the Fed takes some comfort in the fact that jobs are still strong.
Mike, do you want to do the academic debate of the moment, essentially on job openings and whether you can reduce job openings from the level they're at without unemployment rising? Olivier Blanchard, Larry Summers going at it with Governor Waller over the last week.
Yeah, Summers and Blanchard say you can't. Unemployment's got to go up as the job vacancies come down, and Waller says that's not necessarily true. And so far, Waller's winning in the sense that we got the latest JOLTS report, and it showed vacancies going down without unemployment going up. But we'll see after tomorrow. This is going to be a debate that'll go on for a while, John, and we won't know who's right for some time.
I can't say it's an exciting debate, that's for sure, Mike, but it certainly matters.
You're not an economist. I mean, economists, this is what qualifies as exciting.
They're loving it. This is exciting for economists, I know. Mike McKee, good to catch up, buddy. Looking forward to Mike's coverage tomorrow. Payroll's just around the corner. Chris Harvey with us now. Chris, how will you navigate that tomorrow, the labour market report and the incoming data through next week too, the CPI report on the horizon?
Yeah, John, as far as the job picture, we think Mike had it right. It's not a leading indicator. It's a coincidental to a lagging indicator. And one of the things that we've seen is things are directionally not good. And there's a couple of anecdotes. 6 months ago, we had a tech headhunter in, and he was saying, hey, you can go into your boss's office, you don't need another job, and you can get a 20% raise. We had him in a couple of weeks ago. He said, you go into your boss's office now and ask for a 20% raise, you're going to get fired, right? And you're beginning to see these things happen. What I think is by September, you're not going to have to talk to people about return to office because they want to get more face time with the boss. Things are beginning to get tight. We are late in the cycle. We can argue about whether we're going to recession or not. I think we are, but it's late in the cycle, and you should start to see degradation in the job market. CPI, what I think is it's just tricky, right? So what CPI can do, if it comes in hot, right, then what you would expect to see is the equity market to get roiled, Fed fund expectations to go up for a short period of time. I don't think long, because I don't think it's lasting, because other indicators are telling you that things are coming off the boil. But I think CPI is more impactful in the short term to the markets. And if you get a hot number equity markets will pull back for a period of time. If you get something that comes in much lighter, this rally that we're seeing, we think it will continue.
Chris, can I pick up on something you just said? How people will respond to upcoming weakness. Is there a suggestion within that you might get a supply-side response in the labour market as you start to get a deceleration in economic growth?
I think so. I think, one of the things that's also happened is you had problems with, and we looked at the different pockets of the labor force, right? And prime age women it was an area that was lagging. And part of that was related to some of the COVID issues, complications of COVID issues, childcare issues, so on and so forth. That's improved. But what we're seeing for the most part is people are coming back into the labor force. And we think they'll continue to slowly be dragged back into the labor force. Not in leaps and bounds, but kind of in this grind going forward. And you're right. That's something else that we're really not talking about. And that's something else that can weigh on the job picture.
Interesting. That's payrolls. Let's finish on CPI. CPI very close to 9% still if we get a reduction next week on headline. Core could be sticky. Chris, it's back to growth. I know from what you've described, at least it sounds like to me that you're looking for that pre-pandemic playbook that worked so well. The NASDAQ ripping, big tech doing its thing. Chris, where does inflation and what you need to see fit into that call over the next couple of months?
So John, something we've touched on in a not too distant past is we talked about 10-year break-evens. And we said if 10-year break-evens get in this 250 to 275% range, we think that's pretty good for your growth stocks. It's now it's slightly below 250. It's actually been in a range lower than we would have expected, in this kind of 225 to 250 range. As long as it's in this sub 275 level, we think this is very good for growth, because what the bond market's telling you, what the 10-year in particular is telling you, is we're going to stagflation. You have reals pretty much close to zero, plus maybe 25 basis points, and you have break-evens at 250. That's an inflationary environment with not a whole lot of growth. By definition, that's stagflation, and that's good for your growth and your growth stocks.
Where does energy fit in, Chris? Just a final one from me. Winner of the year.
Yeah, so
losing more recently. Your thoughts?
So I think energy, energy is a place we're going to want to come back to probably in another 3 or 6 months. It just fits into that cyclical trade that we don't like at this point in time. But a lot of the policy is going to keep supply pretty tight. And what we've seen from the energy companies is they're doing a really good job at restructuring their balance sheets, at operating on profitability, not growth. And ultimately, there's a lot more quality. There's a lot more value in the space. We just think it's a little too early for that bounce to occur. And so probably another 3 to 6 months is where we get much more interested.
Chris, awesome to catch up. A different perspective when there's so much gloom out there at the moment. Chris Harvey there of Wells Fargo saying you'll see the pain eventually, but ultimately you've got to wait. It's the first half of 2023 where things start to change in a more material way from him and a team, at least. That's their view. Equities unchanged on the S&P. The NASDAQ still doing its thing, up about 1/3 of 1%. Maybe we should consider, and I've raised this a couple of times over the last week, that Marko Kolanovic over at JP Morgan might be right now. He's having his time in the sun. He said this earlier this week: whether it's earnings or the Fed, we see a reset of investor expectations. Risk markets are rallying despite some disappointing data releases, indicating bad news was already anticipated, priced in. He's been looking for a big recovery in stocks. We've had one off the lows, that's for sure. BNP Paribas said something that stuck with me all week on crowding in. With the Fed laying the foundation for a more moderate approach in the back half of the year alongside resilient earnings, we see scope for further upside in the near term as market participants get crowded in. That was BNP. And then Max Kettner this morning of HSBC joining the rest of them, basically just saying wishful thinking. I think that was the title of the note from him and the team at HSBC. Wishful thinking. You get to pick your side. Right now, we're basically unchanged on the S&P. Coming up, the market moving events you need to be watching. Your trading diary just around the corner.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth, and codifying that using AI, sensors, and computers is turning out to be a lot harder. Last but not least, it's a safety-critical system. None of us should deploy until and unless we have closed-loop evidence that we're safe.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 minutes into the session, so far so good, no real drama here, unchanged on the S&P, on the Nasdaq just about positive, up 0.1%. That's the price action. Here's your trading diary. President Biden hosting a roundtable with business leaders on inflation at 1:45 Eastern Time. Fed President Mester speaking later today with Barkin on deck for Friday. And we round out the week tomorrow with the main event. It's the payrolls report just around the corner. We're looking for 250K. That's the median estimate. The high is 325, the low is 50. It's a widespread once again. Tune in right here on Bloomberg TV. All-star lineup. Mohammed Al-Arian, PIMCO's, former PIMCO's Mohammed Al-Arian, BlackRock's Rick Reeder. We'll be catching up, of course, with Mike Collins and Anastasia Amoroso as well. From New York City, this was the countdown to the open. This is Bloomberg.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in side sourced every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of Lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their Lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a Lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of Lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get Rich quick scheme that nearly killed a German soccer team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Gold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that The vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense.